City. I'm Rochelle Akufa alongside Madison Mills. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio, tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
And we've got a great packed show for you this Friday morning. Futures looking mixed on some red-hot inflation headlines. U.S. producer prices rose in January, indicating inflation remains sticky. The Federal Reserve's great rate debate rages on. Atlanta Fed President Raphael Bostic signaling that it's too soon to declare victory against inflation just yet, saying the Fed needs more time to weigh the prospects of interest rate cuts.
Indeed, meanwhile, investors are digesting the latest round of corporate earnings from Coinbase and Roku, both trending tickers on Yahoo Finance. We'll break down what these quarterly results could mean for the market's momentum. So let's get right to it with the 3 things you need to know, your roadmap for the trading day. We've got Yahoo Finance's Jennifer Schonberger, Jared Blickery, and Alexandra Canal with more.
The producer price index clocking in much hotter than expected for January, rising nearly a full % after economists expected prices to drop from December. This latest inflation data comes after Atlanta Fed President Raphael Bostic said he expects inflation will fall slower than markets are pricing in, signaling that rates could remain at current levels for longer than markets expect.
And shares of Coinbase, they are surging after posting a profit for the first time in 2 years. The largest U.S. crypto exchange topping the street expectations on both the top and bottom lines. Coinbase shares riding a new wave of optimism about digital assets thanks to investor interest in spot Bitcoin exchange-traded funds, which the Securities and Exchange Commission granted approval of only last month. The surprising fourth quarter performance also lifted Coinbase's full-year guidance to a net profit of $95 million.
And Roku shares tumbling in pre-market trading. Roku beating revenue expectations. It came in line with the street's EPS estimates, but elevated investor expectations and increasing competition from tech giants like Amazon sending the stock lower this morning. Roku also warning of a more challenging media and entertainment outlook for 2024 as the company looks to prioritize profitability and recover from an uncertain ad market.
First, investors look to more cues on the timing of rate cuts. The fine inflation print for the week, we saw producer prices data coming in hotter than expected, indicating inflation remains sticky. And Atlanta Fed President Raphael Bostic signaling on Thursday that the central bank needs more time to weigh the prospect of an interest rate cut. For more on the Fed's policy playbook, we turn to Yahoo Finance senior reporter Jennifer Schonberger. Hey, Jennifer.
Good morning, Rochelle. That's right. The producer price index clocking in much hotter than expected for January, rising nearly a full percentage point, nearly matching the level in December after economists had expected a drop. Looking at that number, producer prices, this is what businesses pay to make their products. That shot up 0.9% last month versus 0.6% increase that economists were expecting. That compares with the 1% increase from December. Now, those producer prices coming on the heels of a much hotter than expected consumer price report earlier this week that caused investors to push out their bets for when the Fed could begin cutting rates to June from May. All of this as Atlanta Fed President Raphael Bostic became the latest Fed official to caution that the central bank isn't in a rush to cut rates. Bostic saying in a speech last night he expects inflation will decline more slowly than the pace that markets expect, signaling rates will be held at current levels longer than markets think. Bostic saying, quote, "My expectation is that the rate of inflation will continue to decline, but more slowly than the pace implied by where the markets signal monetary policy should be." He went on to say, right now, a strong labor market and macroeconomy offer the chance to execute these policy decisions without oppressive urgency. Now, we will hear from San Francisco Fed President Mary Daly later this afternoon. Back to you.
All right, Jennifer, thank you so much. Let's move over to the crypto world because shares of Coinbase surging in pre-market trading after reporting its first quarterly profit in 2 years. The crypto exchange seen net income of $273 million in its fourth quarter, that driven by the approval of those first spot Bitcoin ETFs. Yahoo Finance spoke to Kathy Wood, whose ARK Invest holds large amounts of coin shares across its entire portfolio of active ETFs. Here's what she had to say about the results.
Well, one of the things that it's doing right is that it is, from a regulatory point of view, the most compliant exchange out there. And it's losing all its competition. I think they're also in the right place at the right time, and they're executing brilliantly.
Executing brilliantly. That is the big question for our next guest. We've got Owen Lau, an Oppenheimer analyst. And Owen, it's great to speak with you. I want to zero in on that quote from Kathy, not to disagree with her here, but when I speak to my sources in DC, they tell me that they're actually excited about Binance and the increase in their budget towards compliance, over 30% more allocation there. To what extent are you weighing compliance budgets as a way to suss out the performance of these crypto names?
I think this is a very important question. That's why last night on the earnings call, I asked the management team that specific question: how much investments they have in anti-money laundering. The answer I got from the CFO was they invested a lot of money into this area, because if you look at the last 1 or 2 years during crypto winter, FTX and even Binance got some trouble in this area. So I think this is a very important area. And Coinbase is a public company, so I do think they have invested enough money in this space. But we'll keep asking this question in order to make sure customers and shareholders understand what's going on.
And Owen, of course, a lot being made of Coinbase being the custodial crypto custodian for these spot Bitcoin ETFs. But we're also seeing the SEC and US lawmakers putting some pressure here, as a lot of these banks didn't get to cash in on that because of these laws they have regarding capital allocation, and really offsetting the liabilities if they were to have crypto in custody. Seeing that potentially moving faster, what does that do to Coinbase's edge?
Well, what I've heard is some of the banking trade group is trying to push the SEC and the Congress to make some regulations to allow some of these banks to hold crypto. Longer term, it could increase some competition in this space, but a custodian is a very sticky business. So I think Coinbase has a first mover advantage. Coinbase has 8 out of the 10 spot Bitcoin ETF as the custodian. So because of this first mover advantage, and Coinbase, it's a critical infrastructure in this space, and these large banks or these large issuers trust Coinbase. So I felt like their position is still pretty strong, even though if the banks can hold digital assets going forward.
Owen, could a newbie to the space take significant market share from Coin at this point?
In my opinion, it is very hard. We saw some newbies. Even FTX was a newbie. They tried to do it with zero or very low fee. It didn't work out well, as we know. Some other companies may come in the future, but right now I felt like after this crypto winter, some of the bad actors are out. Some of the strategy they thought it worked, it didn't work out. So in my opinion, it is very hard. We will see additional entrants in this space, but very hard to steal market shares from Coinbase, I think.
And we do still have a lot of retail investors sitting on the sidelines here, a little bit burned from what they saw in the crypto winter, but starting to see these flows coming back in. Where do you see Coin gaining more market share, especially if you fix in the US? You have Binance they're competing with, and Gemini, as well as Binance and KuCoin globally as well.
They have been actually gaining market share. If you look at the US market, they have been gaining market share from, I think, 62% in July 2022 up to right now. I think it's over 67% in February 2024. And globally, similar thing, because Binance US and Binance have been losing market shares to Coinbase. So I think one of the key competitive advantage for Coinbase is actually transparency, disclosure, and compliance. So if they can bring this to the US or global landscape, I do think they have a good edge to keep getting market share from other global players.
Go ahead.
So Owen, it sounds like compliance is a really important part of your picture here, but when I look at analyst recommendations of the stock, it's incredibly mixed when you look at buys, sells, and holds, about 33% for each of those. Where can our audience of retail investors find the most clarity on this name? What specific data points should they be looking at in sussing out the value of Coin moving forward?
I think Coinbase was widely perceived to be an unprofitable company during crypto winter in particular, but before that, they actually make massive profit. I think going forward, you can forget about the buy-sell rating. Look at the fundamentals. Look at the GAAP earnings. Look at the adjusted EBITDA number. it's that increasing. So this is not opinion. This is the kind of the figures printed by the company. So forget about all this rating, forget about this price target. Look at the company fundamentals such as adjusted EBITDA and EPS going forward. You can find the answer.
And Owen, for crypto enthusiasts looking forward to a spot Ether ETF, what are the expectations there, especially given some of the cold water that SEC Chair Gary Gensler threw on the potential that it won't be the same as the long drawn-out approval that they even saw with spot Bitcoin ETFs?
I have some hope. My expectation is I think there's a good chance that the ETH ETF can get approved by May 23rd this year, but we don't know. I don't know for sure. But if you look at what happened in Grayscale, if SEC were to reject ETH ETF, I think the crypto industry has the playbook how to deal with this situation. I don't hope that would happen that way, but I think if we are going to see a good scenario, if at the SEC approve this ETH ETF, I think there will be probably a win-win for all parties.
Certainly, the door is open. Appreciate you taking the time to join us. Oppenheimer's Owen Lau, thank you so much for taking the time.
Thanks a lot.
All right, also watching Roku shares plummeting, the company forecasting a steeper than expected first quarter loss as it struggles to compete with giants like Netflix and Amazon for advertising dollars. Roku warning of a challenging environment for media and entertainment spending for the rest of 2024. We have Yahoo Finance's Alexandra Canal here with us to break this down for us. Ali, what are you watching?
Yeah, pretty dire moves here in pre-market trading, continuing the sell-off that we saw last night. And it was interesting to me considering we did see that revenue beat double-digit gains in accounts and hours streamed, but we were entering this report with elevated investor expectations. So despite that revenue beat at $984.4 million, some investors were expecting closer to $1 billion. We also saw a slight guidance miss on gross profit for the current quarter, in addition to a 4% decline in average revenue per user, or ARPU, as the company continues to focus on international markets. Although I will say that domestic ARPU was flat to slightly up. But there were implications that platform growth, that operating costs for the remainder of the year are going to be muted, which is leading to estimate cuts across the street. On top of that, there's increased competition from Amazon entering the ad-supported market. I've been reading a lot of notes on the stiff competition there. Roku also dealing with ads from Netflix and Disney. So just a lot more competitors on the market. And then Walmart reportedly buying that budget TV company Vizio. Shares were under pressure from that news. And overall management on the call, they were saying streaming is reaching, it's maturing overall. So because of that, it's not a growth at all cost strategy anymore. They're not spending as much on media and entertainment ad dollars, which really is a big growth driver for Roku. And then you have those macro challenges. The advertising market, it does not seem to be getting better, definitely not on the linear TV side. A lot of the ad dollars are shifting to over the top, to streaming, which could be a benefit to Roku, but you also have all these big tech giants and all the competition entering this space. So, a mixed bag here in this earnings report. I'm also seeing mixed calls across the street. Some are saying that Roku could benefit from being a first mover here, but it's hard when you're dealing with a big company like Amazon. How do you necessarily compete?
It got crowded.
It got crowded,
yes.
And even like you mentioned, Ali, a company like Walmart, which the CEO didn't mention that potential deal on the call. Did that surprise you at all?
It did surprise me, and it did pop up in a few analyst notes out there that, look, this is something that Roku needs to take seriously. If Walmart starts to develop their own TVs, that's a big company too. You got your Walmarts and your Amazons. Roku is a relatively smaller company, so they're going to have to innovate and find other ways to really bring in those ad dollars, because this company is one that's been very focused on profitability. We saw a decent amount of job cuts in 2023, and investors, they don't want to see this company go back to a growth phase. They really want to see them mature. They want to see them post positive EBITDA, which they did say they will do in 2024, just not at the level that investors were expecting. So, it's an interesting time for Roku, and I think 2024, it's going to be a big year for them to really figure some things out.
A show don't tell kind of
Yes,
vibe
exactly.
right now. Thank you so much, Ali. Really
Thanks,
appreciate
guys.
your reporting as always on that. Now moving over to another earnings print. DoorDash shares slumping in pre-market despite solid fourth quarter results. We're going to break down Yahoo Finance's top trending tickers. That's coming up next. DoorDash shares driven lower despite solid fourth quarter results. Total orders and marketplace gross order value topping Wall Street estimates, but the company facing regulatory costs amid steep competition in the food delivery arena. Here to discuss this and more with us is Fox Advisors founder and CEO Stephen Fox. And Stephen, thanks so much for being with us this morning. I'm curious your thoughts about what's going on with Dash here, because the stock is down this morning. I wonder if you see this as a buying opportunity, or is this a shorting opportunity if you believe that this stock is going to continue to tumble?
So it's probably somewhere in between. We fully recognize that, greed is good on Wall Street, but let's put it in perspective. The stock has done tremendously well since the end of 22. It's up about 150% or more. It's done well year to date. It's up 28%. Basically what happened is the company is setting guidance that it believes it can do, taking out sort of that beat and raise expectation from the street, which in the context of the growth isn't that bad, but it leads to some sort of adjustment in the stock price near term.
And Steve, I want to ask you, because when you have this revenue beat, but obviously still not getting rewarded here, but as we hone in on this, gross order values expected to reach between 74 billion and 78 billion. That's up from a year earlier, 66 billion in 2023. Do you think the stock is being unfairly punished on this? And is some of this about the softer consumer as well?
So the sensitivity around that is, well, one, first let's recognize this is a massive number, and the company's built a huge business in the US and now starting abroad too. But the growth is going to slow a little bit in their expectations. So from the high teens in GOV down to maybe exiting the year at a low teens type of growth rate, still very attractive growth for these levels, with optionality down the road for reacceleration as they get bigger in things beyond restaurants, as they've been working on.
So talk to me about the area in which you see the most expansion for Dash moving forward. I know that in your note you talk about international. I'm curious if you think that that's going to be the biggest potential movement for them in terms of where they can get more profit moving forward.
Yeah, so they're very underpenetrated internationally. They also bring to the market, especially with the acquisition they did of Volt, they bring to market, I think, better expertise in terms of managing the logistics and the micro logistics of restaurant delivery. On top of that, we wouldn't discount any of the new verticals that they're going into, especially since they're looking to do that internationally as well. So things like groceries, convenience stores, they're making very good progress in those areas, but they do require investment. We think the core profitability is probably being hit, call it 400 basis points versus, the 4 to 5% type of incremental margins they're getting from just investments. So they are going to invest heavily in these areas, and they have a proven track record of managing these well and turning them profitable.
So Stephen, how well positioned are they against Uber and Instacart as well?
So I think they're all a little bit different animals when you break it down. I think Instacart by far is the leader in groceries. I think, in fact, people are overestimating DoorDash and Uber's penetration in the US against Instacart for groceries. And remember, Instacart is basically US only for their business. DoorDash is expanding internationally now. Uber does very well internationally in delivery. I think DoorDash is proving that they can compete and even gain share against Uber in different markets. You have to look at it where Uber does well, maybe in urban areas versus DoorDash does better in the suburbs, et cetera. But they're definitely going to hold their own. It's a very well-run company, but I think there's going to be differences you're going to have to consider going forward. I mean, in the grand scheme of things, we've been very much more bullish on Uber the last year and a half, 2 years, and now we're looking at Instacart saying this is an undervalued asset.
Well, another similarity between Uber and DoorDash is the announcement of this buyback program, Stephen. I'm curious if you think that Dash's buyback program was a little bit of a shiny object saying, hey, look over here, don't look at our bad earnings print, versus Uber's, which may have been a little bit more about solid cash flow. What's your take on that?
No, I think both companies are really hitting a sort of a sweet spot in cash flow generation and growth in cash flow. So I think while DoorDash's number might be smaller than Uber's as a percent of market cap, et cetera, it reflects that they're growing free cash flows. And in fact, they probably could buy back more stock than what they're saying right now. They're talking about $1 billion. We see opportunity for the cash flows to be even better. depending on how they invest in the future. I think the biggest difference between DoorDash and Uber is you get a better sense in the numbers for how Uber is investing and growing in new categories, new geographies, whereas DoorDash kind of keeps all of that information closer to the vest.
Really important context there, Stephen. Thank you so much for joining us. That was Stephen Fox. We're going to move over to another trending ticker because shares of Roku tumbling after reporting its fourth quarter earnings. The streaming service beating the street's revenue expectations in the latest quarter, with active accounts surpassing 80 million. But Roku signaled near-term challenges ahead thanks to an uncertain macro backdrop and uneven recovery in the ad market. For a deeper dive into the company's latest results, we're joined by Shweta Kajiria, Evercore ISI Director of Internet Equity Research. And Shweta, thank you so much for joining us. You laid out some key questions for the call in your note. I'm curious, did the call change your thinking about this earnings print at all?
Well, first of all, thanks for having me. There were a few things that came out that got us incrementally negative on Roku. A few things. One is that the magnitude of the beat in the fourth quarter was not as robust as what they've done in the past. And two, the first quarter guidance implies growth rate that was less, somewhat slower or muted than we expected. And the management team called out muted demands in their M&E segment, which is media and entertainment segment of platform revenue, which is a high margin business, and as well as tougher comps in SVOD, or their subscription business, because price increases and ad-supported subscription tiers that were launched in 2023 got that revenue segment to be very robust or healthy throughout 2023, and so now they have tougher comps. So for a variety of reasons, the growth rate expected in 2024 is likely not going to be as high as investors were expecting. And then the second thing is on profitability, which is a key thing for this company. And they did a great job by cutting costs. They had several RIFs, or reduction in workforce, and that was in 2023. What management said during the call was 2024 remains a year where they will now think about top line growth, invest some of their profits and gains back into the product and feature upgrades. And so what the implication there is that perhaps the philosophy of their guidance has not changed, but the upside that we could have, investors could have perhaps seen in 2024 to profitability may now be a little bit more tempered. So for those reasons, I'm incrementally a little less bullish on it, or I guess incrementally bearish on Roku.
So Shweta, when you think about where some of these companies want to have ad spend, why would it be a Roku versus, say, one of these bigger ecosystems, your Apples, your Amazon? What sort of edge do you think Roku could have in this space?
Well, Roku has 80 million active accounts, and that is a very large audience. That is a majority of them are in the US, but they have a very good presence in North America and Mexico, as well as in Canada and some of the other countries as well. So having that audience, and some of it that is fully complementary to some of the other platforms, is a huge plus for advertisers. And the fact that they have first-party data of all logged-in users, they know who is watching what, and being able to deliver that return to advertisers on that audience is a key value proposition that Roku offers. The challenge or the question for Roku's differentiated moat and value proposition on a go-forward basis is that with more supply coming in, with Amazon Prime Video ads now coming in, and a lot more other streaming platforms also offering ad-supported tiers, is Roku monetizes the Roku channel the best? Is that app, or is that platform's value proposition diminishing because there is greater supply than there is demand, and there are only so many ad dollars to be circulated? So the draw that Roku has is clearly its audience. However, the question on a go-forward basis is the supply and demand dynamics, where Roku could potentially see some diminishing impact. What Roku is trying to say is that there is still a huge gap between viewership and ad dollar shift to CTV. 60% of viewers have already shifted to streaming, right, but only 30% of budgets have shifted. So as that gap closes, Roku clearly would be a secular beneficiary. The question that investors are asking is whether the secular tailwinds will be greater than the headwinds that it may face with the supply demand dynamic shift.
Shweta, does it matter that Roku customers may not even know that we are Roku customers? We were talking about this in our morning meeting, and I don't know about you, Rochelle, but I have a Roku TV, but I don't think of myself as a Roku customer. Is that an issue for them?
Well, not really. The benefit of Roku is that those folks, and I'm not sure what you think about your Roku, but I have Roku on my TV as well, and I'm pretty satisfied with it in terms of the user experience. So the stickiness that they get from these 80 million users is that once you buy a TV and it has Roku, you don't change your TV for maybe 5 to 7 years. The age of dongles, making a dumb TV smarter, is kind of now has shifted towards just buying a smart TV. And so that's where they build a stickiness of the audience. But as a consumer, yes, we may not care if it's Roku or whether it is Google Chrome, et cetera. But they have the benefit is that Roku has penetrated about 30% plus of the operating system of all the TVs. So there's a greater chance that the next TV any consumer buys comes with the Roku operating system. And that's their edge because of their leadership position of Roku being integrated in some of these OEMs or in these TVs, like TCL, for example.
Well, we continue to track all of that action. Appreciate you taking the time to break this down for us. Shweta Kajuria, Evercore ISI Director of Internet Equity Research. Thank you so much.
Thank you.
All right, well, just a few minutes away from the opening bell, so we're checking in on some of the action that we're seeing. I'm looking at some of the trending tickers that we currently have. We talked about Cisco and some of the downside that we're seeing here currently in pre-market, down about 2%. Twilio and Coinbase also there, of course, still continue to talk about Coinbase and really how it's been able to benefit from the spot Bitcoin ETFs as a custodian of crypto there. Also looking at SoundHound AI and Dataze also as well. And of course, Supermicro Computer continuing to see it's micro, but in terms of the growth that it's seen, really incredible. In pre-market, it's currently up about 14%.
Wow.
And when you think about NVIDIA, you think about the AI play. Interesting to see that Supermicro is still chugging along there and perhaps a cheaper alternative for those who haven't been able to get in on the big NVIDIA boom.
Right, it's such a great point. And I remember earlier this week after that CPI print, all of the Magnificent 7 names were down between 1% and 3%. And NVIDIA was basically unchanged on the day. And it points to this broader picture that these AI-driven chip plays are potentially still being viewed as a safe haven, even if they're overvalued. So to your point, maybe getting in on some of those names that are a little bit more affordable is the right move.
Indeed, and here we are with your opening bell for this Friday. You have UBS, they're ringing the bell at the New York Stock Exchange. And of course, we're also looking at Harboring Hearts there, ringing the bell at the tech-heavy Nasdaq.
At the tech-heavy Nasdaq, it's looking like we're seeing a little bit more green on the screen when it comes to futures in the Nasdaq. Not as much when you look at the S&P 500 here, and of course the Dow Jones. Though the S&P looking a little bit flat. We're going to get more insight into what's driving the markets at this opening bell with Jared Blickery. He is at The Interactive. Jared, what do you got for us?
That's right, Maddie. We just got the Nasdaq first print of the day, just barely in the green. You can see S&P and Dow just barely in the red, so ho-hum, right? But I want to check out the Russell 2000 here. The small caps have had the most volatile week of all the indices. This is a 5-day look, and here was that really steep drop we got on Tuesday. That was on CPI, but look, we bounced back, overcome those losses, and are still maintaining gains of about 1.44%. Now, I want to look at an index I don't look at often, but it's notable. This is a New York Stock Exchange Composite. It's everything that's listed on that exchange, and this is a 5-year look. Pandemic lows are down there. Here were the prior highs in late 21, early 22, and we just exceeded them. So add that to the growing list of stock indices that are at record highs. And we can also take a look at what's going on in the bond market. That's been pretty volatile this week. I'm going to dial this down to a 2-month chart. And here we have yields pressing up against those yields that we got on that big CPI print. Now, the danger there is that if we go higher, that could spell trouble for risk markets, but we're not there quite yet. So not to get too far ahead of ourselves, also want to take a quick look at the US dollar, which has also been pressuring stocks recently. If you take a longer term look, here's a 3-year chart. Just want to point out that we are right against a potential trend line here. If we were to accelerate above, that's another thing that would probably happen in concert with those rising interest rates, but we're not quite there yet. Yesterday in sector action was pretty interesting. Everything was outperforming except for tech. Tech was the only sector in the red. Today, it is the second best sector, actually third now. Materials is in the forefront. That's up 0.5%. And real estate and utilities, which were flying high yesterday, those are taking a backseat. And let's take a quick look at the Nasdaq 100. NVIDIA, is that close enough for a record high? If not, probably happened by the end of the day. Meta down 1.3%. You can see not a lot of dark green or dark red here. And I quickly want to take a look at our leaders. Oil is gaining today after, I believe WTI crude oil was up about 2% yesterday. KWEB, that's Chinese internet stocks, those are doing well. IPOs, Bitcoin, and then chip stocks. So kind of a speculative flavor to those stocks that are in the red in those sectors. To the downside, though, regional banks, which got a nice pop this week, those are trading negative about 1%.
All right, thank you for breaking all of that down for us, our very own Jared Blickery. All right, coming up, stocks mixed on some red-hot inflation data. We'll speak with SoFi's Liz Young next.
Time now for our stock to watch, focusing on Apple doubling down on AI, reportedly looking to complete the next version of its programming software Xcode and release it to third-party software makers as early as this year. And that's according to a scoop from Bloomberg News. We see that moving up Apple, even though it was in the red after the close yesterday, Rochelle. And what's interesting to me about this is it seems like Apple is betting on sort of making money from the developer side, providing this code-driven software to folks who maybe want to use it to develop apps for the App Store. Meanwhile, you have Microsoft focusing more so on AI-driven technology that will be embedded in phones that consumers will use. So I'm curious to see which of those two strategies is going to be the most financially viable one, but certainly looking good for Apple in the trade so far this morning, which is up and beating Microsoft in the early trade.
It's true. I think people are wondering what's going to be that next big push that we see from Apple in AI. We know that when OpenAI was pushing ahead, people were like, why aren't we hearing more from the Apple camp here? But yes, they're reportedly going to have been working on for about a year the software tool for app developers that will compete with Microsoft's GitHub Copilot. Also ramping up development in-house, working on a tool to generate code for testing applications. That's something that they're still doing in-house. But it would coincide nicely with the new version of their flagship programming software, Xcode, which is supposed to be coming out this year. Perhaps we will see it at the developers conference in June.
Right.
Obviously, time ticking, June not that far away, but I think this might be that moment that people have been waiting for to really see Apple step up in this space.
Right. It feels like Apple lets the other guys play in the playground for a little bit, and then they come out and say, well, now we've got the thing that everyone's going to want. They tend to do that, and it works out for them. So to your point, we'll see in June.
It's true. We had mobile phones before the iPhone, and now look.
Right. Exactly. Look at that.
All right, well, we're also taking a look at, of course, wholesale prices in January coming in hotter than expected, making the road to rate cuts even more complicated. This week, Atlanta Fed President Raphael Bostic saying, quote, inflation might come down more slowly than the pace implied by where the markets signal monetary policy should be. Well, for what this means for investors, Liz Young, SoFi Head of Investment Strategy, is here. Thank you for joining us, Liz. Obviously, it's been a week. When it comes to economic data here. Markets really just all over the place when it comes to this. What should we be focusing on? Because it seems like the Fed focuses more on PCE. Investors seem to be looking at everything else or not giving it as much weight.
Right. Well, we don't get the PCE data until later this month. I do think that because of the CPI print this week and because of the PPI print this week, now the data is stacking up against investors in a way that's making people more nervous. So I think there will be a lot more watchful eyes on PCE later this month. But so far what we've seen, and it's just really 1 month, and a lot of people have been saying we were expecting a little bit of a heat up in the January data. Even the Fed themselves, there have been a number of speakers that have said this is still consistent with the path that we were expecting. What we've seen, though, is that investors, I think, are getting nervous about the idea that we could possibly overheat again, and that risk is still alive. So the volatility, particularly the volatility that we're seeing in yields, is telling that story, that we're not quite out of the woods yet, not necessarily that inflation is heating back up and on a new trend. It's just 1 month, but that risk that things could get hotter and not be going down in the linear fashion that we had expected is still around.
So I'm curious then, Liz, if we have that red hot CPI print and then we've got the hot PPI print. I'm looking at the market so far today. The S&P says, we're focusing on the good news. We're focusing on chips and Apple. I'm curious, at what point does the data start to make it difficult for us to be betting on this Fed pivot? When will the market start to believe in this Fed victory lap that's been happening throughout the week?
I interpret it differently. I don't think the Fed is taking a victory lap. I think that they've been pretty consistent with their messaging that we're not confident yet that we've solved the problem, which is why they consistently pushed back on that March rate cut. It moved to May, then it moved to June. And I think that strategy so far has worked for them because expectations of an earlier cutting cycle have completely dissolved. The yield volatility is showing us that investors are reacting to some of this data, but it's going to take, if we get bad data again for February, if things have heated up quite a bit, then I think investors really start to take heed that, okay, maybe we shouldn't even cut rates starting in May or June. And that's where we start to get nervous. So you have to think back about what caused that rally, what drove the rally towards the end of the year last year. It was the expectation that the Fed was going to pivot, that inflation had been solved, that rates were going to come down sooner than maybe we had originally expected. Now we have to unprice some of that expectation. And that's what's happening a little bit here. Equities have wobbled here and there, but only for about a day at a time. What I think would happen is if the data continued to stack up over the next couple months that things were still too hot, then we would have to listen to the Fed, and they would continue to tell us, I think, that rates are going to stay higher for longer because we need to get confident that this problem is solved. And again, one of the things that Jerome Powell has said at almost every press conference, even in his prepared remarks, is that high inflation does not work for anyone. So that is a number one priority. They're going to continue to fight that battle.
So really quickly here, Liz, you talked about the volatility in the bond market. Does the bond market know something that the equity market maybe isn't clued in on yet or doesn't want to be clued in on?
I don't think that the bond market knows anything the equity market doesn't. It's all out there, right? The data is all available. I just think they're queuing off of different things. So the bond market is queuing off of the rate path. The bond market is queuing off of the fact that the yield curve is still inverted and that we still have some concerns about what rates will look like and how quickly rates will return to what the bond market would consider normal. Whereas the equity market right now, I think, is queuing off quite a bit of momentum, quite a bit of late cycle behavior, which does typically drive funds into large cap companies. There's still this idea of the theme of AI and this enthusiasm over it, and the fact that those companies have worked and continue to work. So investors have not been told or proven that they should be taking money out of them. So I think the equity market is just queuing off of something a little bit different from a momentum perspective. And one of the positives about this is that we are hanging on earnings. We are listening to earnings more. And I think that's starting to be a more rational place for the market to be. You want markets to react to fundamentals. The difference is if markets are reacting to fundamentals in an overly enthusiastic way, or if they start to punish an entire industry group because of one company's report. And I think that's the risk that we are facing in this concentrated market.
And so, Liz, when you do have a lot of this frothiness with every bit of economic data that comes out for markets, is this the time for some of the perhaps more beaten up sectors for people to start picking up there, get a bit more defensive here?
Yeah, I mean, sure. If you look at valuations, if we're looking at this purely from a valuations perspective, which is not what I think the market is doing today, but if we're looking at it from a valuations perspective, it would make sense to look at some of those sectors, not even necessarily beaten up, but the ones that have not kept up and the ones that we are hoping to participate in a broadening out. One of those last year was industrials, but industrials has now had a pretty nice run. And a lot of people would point to that as confirmation that the market is doing better and the economy is doing better than we thought. Some of the places that I would look are things like dividend paying stocks, which do tend to skew more defensive. So you usually see things like consumer staples and utilities as the top sectors. But there are some dividend ETFs out there that have industrials as the second sector in them. And as rates come down at some point in 2024, or maybe we don't know when yet, but as rates come down at some point in 2024, dividend stocks may start to look much more attractive to investors who can no longer get 5% in a money market or 5% in a 2-year treasury. So that would be one of the spots that I would look where you can check both boxes with defensives and dividend payers.
That might be one reason we saw Meta adding about $200 billion to its market cap in one day after that dividend announcement. Liz, thank you so much for joining us. Liz Yun, always a pleasure to get your insights. That was Liz Yun, SoFi's head of investment strategy, joining us. We're going to have all of your markets action ahead, so stay tuned right here. You're watching Yahoo Finance.
Let's take a look at another trending ticker we're watching this morning. Trade desk shares jumping higher after seeing sales climb 23% from a year ago and giving an outlook for the current quarter well above expectations. The company's CEO saying the results are a testament to the growing value that advertisers are placing on the open internet. And so with this revenue beat and this upbeat guidance, some of the modeling that they're looking at for their outlook, at least 478 million in revenue for the first quarter, along with about 130 million in adjusted EBITDA, much higher than the street was predicting here.
Yeah.
And for people who aren't familiar with this company, they basically help other tech companies with targeted advertising across different mediums, whether it's streaming or connected TVs, and clearly seeing a lot of room to run here.
And to your point, different mediums. That seems to be the key differentiator between the trade desk and other players in the space. And it was interesting. It looks like they've been up about 10% in the past couple of months, even leading into this report. And then you can see on the chart here just that boom after we saw that earnings print overnight here. But it's interesting when you compare this name to what we were talking about earlier with Roku. Clearly an indication here that the digital advertising market has legs, but we're seeing some other names in the space not being able to capitalize on that. So it seems like there's maybe a bifurcation in who's able to get some more juice to squeeze out of this market.
It's true. We saw on the earnings call Jeff Green, the CEO, saying more and more of the world's leading advertisers are gravitating to channels and partnerships that offer precision and premium value at scale, such as connected TV and retail media. We're still continuing to see this sort of hyper-personalization. And we saw that when we were speaking to some of the analysts talking about Super Bowl advertising, how depending on where you were and which region you were in, the really sort of hyper-focused targeting there of ads, which appears to be paying off here. They were saying that nearly all areas of digital advertising in 2023 outpaced with almost, we're looking at 1.95 billion of revenue. That's 23% growth year over year, a record $9.6 billion of spend on their platform there.
I wish that it would get a little less targeted when it comes to my Instagram ads, because that would be better for my consumer spending and my personal inflation print. But to your point, it's definitely making a big difference when it comes to the broader earnings picture, which I know is what we care more about than my personal earnings picture.
All finance is personal. The algorithm knows how to get all of us.
True. Yep, that's right.
All right, well, stick with us. We have all your markets actions still ahead. Stay tuned. You're watching Yahoo Finance. The bullishness on NVIDIA continuing this morning, the chip maker getting an outperform rating from Loop Capital, which set a Wall Street high price target on the stock of $1,200, implying a 65% upside. But the highlight of the note is this: we're going to party like it's 1995. That's, of course, referring to the dot-com bubble of the 1990s here. I mean, this is fascinating to me. I mean, this is Ananda Brewer leading on this note here. That $1,200 price target, which is a 63% appreciation, and they're actually saying we don't believe NVIDIA is expensive at that $1,200 price target. And so they were really sort of erring on the more conservative side. They said they were leaving a lot of revenue, GM expansion, and EPS if they followed what the work was saying to the letter. Now, this actually beat what we saw with the $1,100 price target set out by Rosenblatt Securities last year. So clearly a lot of upside. You have to wonder, can NVIDIA meet these lofty expectations here?
Really lofty, and it looks like the average price rating is around the 750 range, so very much so outpacing the rest of the street when it comes to their thinking. But also, I saw that Barclays increased their price target on the name this morning as well, from 650 to 850. So I have to wonder too, I spoke with Steve Sosnick about this earlier this week, the degree to which February 21st is going to be such a critical event for the markets. It feels like it should be CPI day, like we should be treating it like a blowout the rundown day on our coverage end of things, because we are watching NVIDIA so closely. There's so much froth around this name. If they don't come through, which in their last print they beat on everything, and still the market dipped after their earnings print. So if we see that action again, that could be a very critical event for markets next week.
It's true. They basically have to beat the beat.
Right. Like
it's lofty expectations, but I mean, look, obviously still very early days in what we're seeing with the development of generative AI and the role that NVIDIA can play. Also looking at some of these other semis also benefiting here. You've got Applied Materials, you've got SMIC, which continues to be the one that's also benefiting from the generative AI boom and not riding NVIDIA's coattails, but at least if NVIDIA is that ship that's lifting all boats, as you mentioned there, you do have to wonder then when they do report earnings on the 21st, what does that mean when you do have this hyper concentration here?
Well, and it's so interesting because when we were talking about this, just as of a minute ago, Supermicro Computer is starting to erase their earlier gains. So I wonder, too, as we get closer to the earnings print, are we going to see some profit taking? And how is that going to lead to more volatility in the space? It's all fun. And it gives us lots of good stuff to talk about.
It's true. I mean, and you know there's going to be some profit taking. I mean, I'm sure people don't want to pull out too early here.
Right.
I mean, especially when you're looking at a $1,200 price target on NVIDIA.
It's crazy.
But clearly, you know, after the tech rally we had, some uncertainty about the macro environment, Fed looking at holding longer than people expected before we get those rate cuts. So, yeah, definitely the one to watch indeed.
Right. A data-dependent soup over there. And coming up, we're going to be breaking down the consumer sentiment data. We're going to talk to a Citi analyst on his latest bullish S&P 500 call. That's all ahead. Stay tuned for more.
I'm Rochelle Akufo alongside Madison Mills. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up. Stocks lower after producer prices came in hotter than expected, adding to the trend we saw in CPI earlier this week, showing inflation may be stickier than anticipated. Also taking a look at some individual trending tickers, shares of restaurant software company Toast jumping today after announcing in its fourth quarter report it will cut 10% of its workforce. That's about 550 employees. The company joining the long list of tech names slashing headcounts. Toast reported better than expected results in the quarter, but growth continued to slow from its 2021 surge. And another company announcing job cuts, Nike, also looking at that stock currently off about 4%. That's after announcing it will cut 2% of its total workforce in an effort to slash costs amid demand pressures. That sluggish consumer demand story still also worrying Oppenheimer, the firm downgrading Nike to perform from outperform, saying they are, quote, increasingly concerned about the company's top-line trends over the next few quarters. Also looking at Yelp, those shares falling after issuing weaker than expected guidance for its first quarter as well as the full year in 2024. The company warning that macroeconomic pressures and softer demand impacting its restaurant and retail segments. Yelp did have a very strong 2023 though, with revenue hitting a record $1.34 billion and net income tripling compared to a year ago. Continuing to watch though, that softer consumer data.
And we're going to look at some of the consumer sentiment numbers that are coming in here. I want to start with the headline number. Sentiment for Michigan. February's current conditions fell to 81.5 versus 81.9. The headline number, though, being February consumer sentiment rising to 79.6. That was a little bit of a miss. The estimate was 80 there. So that headline number, 79.6, but the street was looking for 80. That was the expectation. Michigan February expectations index rose to 78.4 versus 77.1. That was a little bit of a beat. Michigan's year-ahead inflation expectations rose to 3% versus 2.9% prior. So just a little bit of a hotter than expected inflation expectation there. And the 5 to 10-year inflation expectations were unchanged at 2.9%. So seeing that unchanged inflation expectation, that is going to be a positive, but we are seeing a little bit of movement to the downside when it comes to the market trade off of that headline, which was just a little bit of a miss when it comes to the consumer sentiment headline number there, Rochelle.
It's true, it's interesting. We keep talking about the state of the consumer, comparing the sentiment that they have with the spending and the debt that they're continuing to take on. So seeing it then falling there in February, though, keeping in mind some of the seasonality that does tend to be baked in that we saw in some of the January data. But it does speak to that resiliency of the consumer. They continue to perhaps trade down, not feeling as great about the road ahead. We know that there does tend to be some pullback for consumers in an election year as they sort of have a bit of uncertainty about what the path ahead looks like, perhaps don't want to splash out on that big ticket item or make any big changes when you don't know what's going to happen come November.
Well, it's interesting, though, to, again, kind of look at what's happening in the market here because the S&P was up in the early market trade coming off the opening bell at 9:30, and we're now seeing it solidly down 0.2% in the S&P, 0.8% in the Nasdaq. I do think that's primarily driven by some profit taking, some downside that we're seeing across the semiconductor space. We noted that SMCI completely erasing its gains over the past 10 minutes here. That could be part of what's driving this downward trend a little bit more so than this sentiment data, because as we've seen throughout the week, the street is continuing to look past a lot of the macroeconomic data and instead focusing on the individual data. It's interesting, SMCI falling 15% in just 10 minutes after just briefly crossing around $1,000 a share. So maybe a little bit of algorithmic triggering going on with that name this morning.
Indeed, continuing to watch all of that frothiness.
Yep.
Well, also looking at Citi, reiterating its S&P 500 year-end target as 5,100 this week. The firm noting earnings as a positive surprise, trending above average. This week, we had Mohamed El-Erian, Alliance Chief Economic Advisor. Here's what he had to say on what traders should be watching.
Earnings call. I listen really carefully to earnings call. You can start putting an image together by listening to different earnings calls and what they're telling you about what they are seeing. Companies are at the forefront, and they have a much better sense of what's going on the ground at turning points. And this could be a turning point. So listen carefully to what companies are telling us.
Well, we have the analyst behind that call, Scott Cronert, Citi Research Head of U.S. Equity Strategy here. Good to see you. So obviously still seeing this frothiness in the market this morning with every bit of economic data that comes out. Walk us through this bullish call you have for the S&P hitting 5,100.
So, I mean, we've been bullish, going back to the middle part of last summer. It's been predicated essentially on gradually getting to a point where we get a changing Fed narrative and we move away from the hawkish dynamic of the past year or longer to something that's, let's call it, less restrictive. Now, at the same time, we've been arguing for some time this messaging on earnings resilience, that we felt that even in a mild recession scenario, S&P 500 fundamentals will hold up better than typically perceived. We've been getting that. And so we think that that mantra, constructive on fundamentals, even through an economic cycle, really underscores our more positive view.
Well, Scott, it's great to speak with you because we just got this University of Michigan sentiment data kind of adding to the inflation gloom just a touch, signaling that, the consumer is still concerned about the inflation picture. And that comes after a week of hotter than expected data. So I'm curious, to what extent do you think that the market is sort of mispricing this continued question mark in the room about whether or not the Fed actually has tackled inflation and they can start to discuss a pivot?
I think it's the $1,000,000 question right now. So you're spot on this. So the way we've been framing it is that we've had this strong rally, let's call it since the beginning of November, which is in response to 10-year yields coming down from 5 to as low as 3.8. What that has done is really increased a soft landing profile around the broader market setup. But what's happened is that move has come before we've actually seen a more defined earnings turn in many more cyclical parts of the market, including the consumer side. So essentially what we're suggesting here is that, is that 10-year nominals become your really important interest rate benchmark to keep an eye on, in our view, more so than Fed funds. We think we're going to get the Fed funds pivot eventually. But again, what we're arguing here is that equities are really going to respond to a lower 10-year nominal, which is what we're not getting courtesy of some of the macro data today.
And so when are you expecting to see perhaps a broadening of growth beyond the Mag 7 or the Fab 5, depending on whether or not you include Apple and Tesla in that? But when do we expect to see that broadening out, given how concentrated this rally has been in these tech names?
Well, we think it really sets up that we're going to begin to see it in some parts of the market, we think, as we go through Q1 and then into Q2. For many other areas, it's going to be second half driven. So the issue right now, again, we have a 5,100 target, doesn't look like much upside from where we are currently. Paint us constructive on equities and equity fundamentals, but we do have to acknowledge that we've had a lot of price action ahead of the fundamental follow through. That has us in a buy pullback mode, but it's, again, in the context of a more constructive view. From a sector perspective, we're going to see broadening this year. We're overweight tech, but we're also, from a barbelling perspective, overweight industrials, which we're quite constructive on structurally, and we've recently moved to an overweight on financials. In both of those cases, we're going to see, I think, the fundamental broadening effect begin to unfold in the first part of the year, really kick in the second half of the year.
Where can I be looking for evidence of more broadening, Scott? And honestly, let me change that question because I'm curious whether I need to even worry about the broadening. If I'm in the Magnificent Seven and I'm getting record-breaking highs every single day, why do I need to care?
Well, because I do think, well, there's a couple of elements to it. We're quite constructive on the mega cap growth cohort. Let's get that right. The fundamental dynamics here are uncanny in terms of the earnings growth and free cash flow generation coming from many of those companies. They do become more idiosyncratic in our view. Stop thinking of them as a group of 7, 5. We think they're going to each begin to beat more to their own company-specific drummer, so we have to be attentive to that. The broadening effect, though, is really that it's, in our view, really difficult for the S&P 500 as an index to push materially higher just on the backs of this small cohort of companies. You want to see broadening into a more diverse array of companies, whether they're economic sensitive or perhaps even defensive, in our view, as a means of really creating a more structurally solid foundation for the S&P.
Scott, real quick before we let you go, what's more important, NVIDIA's earnings next week or continued Fed speak?
I think it's mostly Fed speak. I can't say it enough. We want to keep an eye on 10-year nominals. We're much more comfortable with the mega cap growth setup with 10-year yields closer to 4% than 4.5%.
All right, getting a fellow Fed fan here. Scott, thank you so much for joining us. We really appreciate your insights. That was Scott Cronert, Citi's research head of U.S. equity strategy, joining us on all things Fed and the magnificent 1, 2, 3, 4, 5. Pick your number there. Now, moving on to D.C. here. The House will not pass more stopgap spending bills to avert a potential government shutdown. That's according to Representative Tom Emmer of Minnesota this week. For more on what this could mean for future shutdowns, we've got Yahoo Finance's reporter Rick Newman. Rick, what do we need to know about these developments overnight from D.C. here?
Well, when he talks about a stopgap funding bill, that's these temporary funding bills because Congress cannot just come up with what they're supposed to do is pass these annual spending bills, the funding bills for each department of the federal government. And they've just gotten far away from that during recent years. The practice has been they can't agree on what should be in the big spending bills for each department. So sometimes it's what they call an omnibus bill, which is a gigantic spending bill that has everything under the sun in it, and nobody really knows what that is because they don't have time to look at, so it's all larded up. Or they just keep passing these short-term spending bills. Here's the money for a couple of months. So the Republicans who are now in charge of the House, when they gained control this year, they said, we're not going to do that anymore. We're going to bring back regular spending habits, and we're going to create the proper order here. And big surprise, they have not been able to do that. So what Tom Emmer is saying is we're facing this new deadline when the temporary spending runs out. There are two deadlines, March 1st and March 8th. And what we are going to do is we're really going to fund the government this time. But the flip side of that is if they don't, and they don't do another temporary spending bill, then we are in a government shutdown scenario. And where are the members of the House right now? They're on leave. So I'm sure all Americans can relate to this. When you have a huge project due at work, the natural thing is everybody leaves town for 2 weeks. That is what Congress has done, and they're going to come back 2 days before the first expiration of that spending level.
So, Rick, being with that crunch in the calendar, then, what are some viable alternatives other than this, then, other than a shutdown?
Well, it's possible they could come up with a permanent spending bill, but I mean, this is how ridiculous this is. The government's fiscal year starts on October 1st. So by the time we get to March 1st, we're already going to be halfway through the fiscal year. And so if they do pass a permanent spending bill, it's only going to be for 6 months, and then we're going to be back where we are again on October 1st. So, so the members have left. I guess the staff that writes these bills is still working. So while the members are away on vacation or talking to constituents or wherever they are, there will be some people still working, but they're not the ones who sign on the dotted line. So I guess the options are government shutdown, which is, just as a loser politically, it's a loser. It's just dumb. Nobody likes it. Voters hate it. And it's the opposite of the order the Republicans said they were going to reinstate. Or they could, maybe Tom Emmer is wrong, and we just do end up with more temporary spending bills.
And of course, if they do extend that to that extra 6 months, pushing us right up against the election, certainly something that no one wants to have hanging over them heading into election season. Appreciate you, as always, our very own Rick Newman.
Yeah, guys.
All right, we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. We have breaking news from the streaming world. According to the Wall Street Journal, Paramount and Comcast are in talks to join forces in a new streaming venture, adding to the trend of consolidation in the sector. We have our very own Alexandra Canal here with the latest. So these two streaming apps potentially under one roof. What do we know?
Yes, so this is a report from the Wall Street Journal. I reached out to both companies for comment. They have not gotten back to me at this point, but Paramount, it hosts a decent amount of content. We have the Taylor Sheridan universe, we have Star Trek, and you can also simultaneously watch NFL games that are on CBS on Paramount Plus. Then if you take a look at Peacock, they have shows like The Office. They also have a big live sports presence with soccer and football. So you'd think that the combination of this would leverage the opportunity for both of these companies to just have more content under their roof, in addition to more live sports. And live sports has really been viewed as the last frontier of the streaming wars. This comes on the heels of that joint venture announcement between ESPN, Warner Brothers Discovery, and Fox. And when this first broke, initially I thought, okay, so this is in response to that. It seems like to me, because at the end of the day, there's a lot of debt for these companies, especially when it comes to their streaming ambitions. This could be a way to help with cost savings. But at the same time, Paramount is one of those companies that has been floated around as a potential acquisition target. We've heard Byron Allen has made a bid. Reportedly, our parent company, Apollo Global, is interested, Skydance Media. So there's a lot of interest in Paramount as a company for its assets, for its film business, and even for Paramount Plus. So if you were to combine Peacock with Paramount Plus, I wonder how that could shake up the M&A landscape as well. But we're seeing both of those stocks down right now. The broader market is lower as well, but just interesting to see even more consolidation in this space. And it seems like, once again, the big driver of this is sports.
Well, you mentioned that the market reaction is a little muted and it is a down day so far, but I'm curious whether or not this is an indication that the street is maybe not thrilled about this news, or do you think that it's more just a wait and see? If we have more information moving forward, it looks like, again, all of the names that we've been talking about are down today, but 1.8% on relatively good volume for Paramount in the red makes me think that there's something bigger here.
I think there's a wait and see, but you have to remember a lot of these companies are legacy media companies, right? So if you focus more energy on sports, you create these joint ventures, and the emphasis is, okay, we want to drive people to watch sports on our streaming platforms, not on linear. That is risky, because at the end of the day, linear is still profitable, right? It's declining massively within cord cutting, but it's powering a lot of the streaming business. So I think when you have a company like Paramount that has a lot of linear network exposure and they want to drive more people to streaming, that's automatically a red flag to investors. Well, what does that mean for their bottom line moving forward? So I think that's one thing. Another question mark is, what is all this going to cost the consumer, right? Like, we don't know what the ESPN, Warner Brothers Discovery, Fox joint venture is going to cost. If we see a combo here, is that going to be an increase in cost? What does that mean for average revenue per user, or ARPU, which is a big profitability metric? So still a lot of unknowns here that I think, investors, they want some clarity on. But 2024 is the year, I think, that we're going to see some deal making in this space, or at least set us up for some serious moves in 2025. And clearly, these reports are just the start of that.
A great beat for you, Ali.
Yeah,
right?
a lot going on. Always busy.
A busy day. And of course, there's those lucrative sports ad dollars and licensing.
Exactly.
Fascinating stuff.
Thank you
Thanks,
so
guys.
much, Ali. Really appreciate it. We're going to move over, sticking with entertainment, though. DraftKings is rebounding today after its fourth quarter results missed estimates, despite posting a 44% jump in revenue from a year ago. The sports betting company also expanded its sports book to Maine and Vermont and announced it'll acquire lottery app Jackpot for about $750 million. So for more on the quarter, we are joined by Chad Bynan, Macquarie Group Senior Analyst. Chad, thank you so much for being here. Talk to me about your headline reaction to this print. What's sticking out to you the most for DraftKings?
Sure, thanks for having me. Yeah, the controllables came in better than expected. So in the fourth quarter, there were some customer-friendly outcomes. So what that means is the public actually did okay against the sports books. That generally reverses in other months. But in November, particularly during the football season, customers did very well. So it was a slight miss. However, if you adjust for that, it was a massive beat for the fourth quarter. And then more importantly, for 2024, DraftKings increased their revenue guidance, increased their profit guidance. This is a company that's expected to grow 20 to 30% this year. And then they actually put out guidance into 26 and 28, and they believe they can continue to grow mid to high teens, which is very favorable from our investor standpoint.
And Chad, we remember when there were all these promotions and we were wondering how that was going to bite into the bottom line. What phase is DraftKings in now? Where does the growth story go from here?
That's probably the most important point here. Sales and marketing for 2023 was roughly flat. It was up 3% for the year, right? And they actually got into some of the new markets that you talked about. For 2024, despite getting into new markets like North Carolina and Puerto Rico, sales and marketing spend will actually come down. And the reason is the older cohort states will just see less advertising. So if you're in a state like New Jersey, who's been legal for some time, sorry to say that you'll probably see fewer ads on some of the sports channels. That's a big driver of profits for DraftKings, and that's kind of where this scale is finally, taking over, where sales and marketing, SG&A are roughly going to be flat for the next couple of years. Obviously, if you saw a California, a Florida, a Texas legalize, maybe you see a little bit of an improvement. But this is really the point of the cycle where you want to own companies like this, and it's a 20 billion market cap company, and it's a leader with FanDuel at this place.
So I'm curious then, Chad, when you think about risks for the name, you talk about legislation. I think about cybersecurity and the reports that we've been hearing about increased cyber threats to folks who are utilizing these sports betting apps. To what extent is that a factor in your consideration of potential downside for this name moving forward?
Fair point. On the land-based side, the third quarter was certainly a disappointing situation out in Las Vegas when Caesars Entertainment and MGM Resorts were both victims of cybersecurity, and there were others within the casino space as well. Obviously, in the digital world, there are arguably more risks. So for companies like DraftKings, that is a risk. They've built this team to be bulletproof in many ways. They really scaled up almost too aggressively in the early years, and that's why the stock had suffered during that time period. But in 23, they kind of held headcount or maybe even reduced headcount. That helped the stock increase 200%. But I think a lot of the things that they've put into place in terms of really protecting customer data puts them in a good position. It also creates a moat versus some of the smaller companies that are trying to grow. We're just learning how expensive it is to make sure that you're protecting your customer data and then also drive revenue as well.
And Chad, obviously a lot of people waiting for California to get on board with sports betting, not there yet. But I do want to ask you about Jackpot, obviously expanding into more of the lottery here. How does that play into the ecosystem?
It's a really interesting company. So the lottery industry, it's a $90 billion revenue industry, and it's in over 90% of the states in the US. It's actually grown higher than GDP for the past 10 years. So despite what some people think, it's been a very positive sector, and that continues to grow alongside gaming. Jackpocket essentially is the courier for lottery tickets. The founder, he tells a story that his father would go to the bodega or the local retail store every day and buy his numbers, right? And that was just part of the day, and it would take up anywhere between 5 and 30 minutes every day. Well, Jackpocket's founder came up with this system where you can actually buy it digitally, and then they actually had people that were going and buying the physical tickets. So it kind of disintermediated the lottery industry, or actually grew the lottery industry. So it's expanding. They have incredible technology. It's a very profitable business. DraftKings believes that this helps them from a customer acquisition standpoint. There's going to be opportunities to cross-sell into the different areas. And iLottery, which is buying lottery tickets through other companies that are partnered with the government, has been really slow to roll out. So that would kind of be the risk if the major lottery companies, there's really only 2 in the US that kind of controlled the situation, if they were granted the opportunity to run iLottery. But Jackpocket, it's a great growth story. I think Series A few years ago came in at a $50 million valuation. So to see it sell at $750 with all the growth is a great success story.
Certainly a fascinating opportunity there. Appreciate you joining us with your insights. Chad Bynum, Macquarie Group Senior Analyst. Thank you so much. Have a great weekend.
Thanks. You too.
All right, coming up, we'll be looking at what's in store for the real estate sector. That's on the other side of this break.
U.S. housing starts fell by the largest amount since April 2020 this January, signaling a slow recovery for the real estate sector as buyers wait to see mortgage rates lower. Let's bring Yahoo Finance's Danny Romero in to give us the details. Danny, what are you looking at most this morning?
The drop in housing starts last month really reflects the wintry weather rather than a pullback in builder confidence. Remember, builders need good weather to build, and so that does complicate the situation in the wintry months. So let's dive into those numbers. Housing starts reached an annualized rate of 1.33 million units, and that was lower than December's 1.46 million units. And that drop really was led by multifamily, which a lot of experts that I've spoken with really believe that this area will continue to be really the sore spot as there's been so much supply under construction. Single family starts slowed last month, but it's still pretty intact there. Moving over to the building permits, a good indicator of future construction projects, that dropped to a 1.5 million annualized rates, and permits for single family edged up, while multifamily permits fell by nearly 8%. That was the most since September. Wow. But another thing to really point out from this government data is that the biggest drop in housing starts also came from the regions that were hit by winter storms. So for example, in the Northeast, housing starts were down by 20% month over month. So looking ahead, economists expect that single family starts will gain their momentum this year. The fact that there has been so much demand in the new home market, and because of that demand, really we have to give it to the builders, because the publicly traded builders have been offering these nice juicy incentives for buyers.
Indeed, we know they don't last forever. All right, well, housing starts and building permits both took a hit in January. Housing starts in particular falling 14.8%. Both signal continued weakness for the real estate sector amid elevated mortgage rates. Let's bring in Jim Tobin, National Association of Home Builders CEO, to discuss. So I want to start with your big takeaways from this latest housing start data.
Well, we always know that this year was going to be bumpy, so I'm not surprised to see it reflected in starts and permits. So single family showing a little bit more resiliency than multifamily, and we've known that was coming. There's over 900,000 units currently under construction, the most since 1973. But the pipeline behind all of those units is a little bit drier because of the cost of capital. So again, not surprising to see multifamily lead these numbers down, but single family generally reflects our own HMI index, which shows that our members are getting more optimistic. It was up 4 points this month. So we're still feeling good on the single family side.
Lots of data this week. What concerned you the most about your view that we're entering this housing renaissance?
Well, I really think the inflation numbers this week remind us that we are still coming out of this, that we're not there yet. Shelter inflation continues to be a driving force of that elevated inflation number. That will, again, in the rental sector in particular, as these units come on board, we predict we're going to build probably 5% more single family units this year. Again, more supply is the answer to the problem. But the inflation numbers, if they continue to stay persistently higher, that then calls into question whether or not the Fed is going to cut 3 times. Maybe they only cut 2. And then when do they cut? This idea that they were going to cut in the spring seems to be off the table now.
So then as we look at the demographics who are able to take advantage of what we're seeing with single family and multi, is it really about those at the sort of upper end of the earnings capacity versus those who are still trying to get into their first home and maybe can't afford it, when you figure in adding loans on top of the cost of the house?
Yeah, I really think it's that low end of the market, the lower end of the market, that first generational home buyer. There aren't any existing homes for them to buy, and that's traditionally where they have juiced the markets from the bottom usually, and gets that churn going. You sell your starter home so you can move to get your next move up home. The move up home then becomes your retirement home. We just don't have that right now because so many people are still rate locked. I think I saw a number, it's either 70 or 80% of mortgage holders have rates less than 5%. Well, they're not gonna move, at least now, certainly with rates starting to creep back towards 7%. So that's really the story here, is we've got to get those first generational buyers back into the marketplace. We don't have the stock to do it.
Can more supply outweigh a 7 handle on mortgage rates?
Well, we think more supply comes along with lower mortgage rates. We still are predicting the Fed will cut at least 2 times this year, and we think mortgage rates settle into the 6s this year. We probably don't get into the 5s by the end of the year, but certainly between 6 and 5 and 6.5%. It's really when we get into 2025 that we start seeing rates really, we think, settle what is the new normal, which is 5.5% in there. And that's when this generation of buyers recognizes we're not going back to 4 or 3% mortgages, that's when the floodgates open. So our members are still optimistic. Our numbers show that. I travel all across the country in completely different markets, and everyone's feeling good about this year, but really the next 5 years.
And are you seeing much in terms of labor pressure? Obviously, it's still a very tight labor market here. How is that affecting what you're seeing with home builders? Labor continues to be one of the most persistent and biggest drags on the economy, or at least on the housing economy. So for us, there are about 400,000 jobs open in construction month after month. That's been about a decade. We're just not replacing the skilled labor in the construction industry to bring those new workers in, to put more workers and drive down the cost of housing. So that is going to continue. That's why we need immigration reform, and that's why we need to make sure we're really investing in job training, in skills training for kids, talking to parents, getting people to understand that the skills are plan A, not plan B if you can't go to college. But labor is going to continue to be a drag on us for a while.
Is there any indication that AI could improve productivity in the markets that you work in?
Yeah, we're actually looking into that. I do think in a variety of ways. And in fact, we're getting ready to go to our big trade show in a couple of weeks in Las Vegas, and AI is actually going to take a center stage when it comes to a lot of our education sessions. I do think that there is a role, whether it's architecture, whether it's finding problems. I've heard, you can use AI programs to solve some of your punch list items before you turn the keys over to a new homeowner or a new renter. I think it's going to help use materials better and more efficiently. So I think we're on the cusp of AI really leaning into the building sector and making us more productive, and I think reducing costs.
Nice. I asked ChatGPT to look at my new lease for me and tell me if there were any red flags, and it seemed fine.
Yeah,
so
good.
Fingers crossed that it was good, Jim.
Right.
Thank you so much
Thanks
for
having
joining
me.
us
Great
in
to be with
studio.
you.
We really appreciate it.
Thank you.
Thank you so much. Now, moving forward here, we just had Jim Tobin on, but stick with us because we're going to have all of your broader markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, Fed Vice Chair for Supervision Michael Barr names commercial real estate loans a big risk for regulators. He says, quote, the reduced demand for office space and higher interest rates have put pressure on some CRE valuations, particularly in the office sector. supervisors have been closely focused on banks' CRE lending. Now, bank stocks have been in focus for investors since New York Community Bank Corp posted large losses over the course of the month, warning of more pressure to come. So joining us to discuss the fallout for banks in this environment is Ibrahim Poonawala, Bank of America Senior North American Banks Analyst. Ibrahim, it's great to have you on. Talk to me about your reaction to these comments from Barr. I mean, we know that commercial real estate has been kind of the zombie in the room. Did any of this surprise you?
No, so thank you so much for having me. And none of this is surprising, right? We've been talking about commercial real estate being a pressure point for the industry, I would say, for the better part of the last 2 years, right? And I think, as you called it out, where we are seeing stress for the last year, and all the banks that we cover have been building reserves against future losses, primarily in terms of the pressure that we are seeing in the office CRE market.
So, Ibrahim, what are the other stickier parts? I know there's a lot of focus on office when it comes to commercial real estate. What are some of the other sectors that are also under pressure?
So it's a bit more nuanced, right? Once you move from office to any of the other CRE subsectors, and multi-family apartments is something that's getting a lot of headlines. But remember, what we see in office is a structural shift. There are buildings which are old, dated, and empty, and no one's going to reoccupy them absent tons of new capex that goes into these buildings. If you look at multifamily that I just mentioned, could be a bit of a pressure point over the next year or two, is tied to the fact that we did see some overbuilding maybe, or a lot of supply coming through in some of the Sun Belt markets over the next few years. That could pressure some of the new construction that's coming on in terms of the rents, etc. So what does that mean? Like, you could see some more restructuring situations, and you might see some more projects that get halted and such. So yeah, they could add to losses. But again, the loss content on cash flowing commercial real estate, if there's an apartment building that's 100% occupied, that's still cash flowing. So I think that's where the difference is in terms of the loss that banks may experience on office versus multifamily.
Ibrahim, I want to talk about some data that we have from the New York Fed this morning showing that consumer borrowing costs rose 24 bips last quarter and nearly 100 bips in the last year to almost 4%. That's the highest level since Q4 of the year 2000. I'm curious, to what extent does that read into some of the bank names that you cover?
So you're right. I mean, again, this was the intention of the Fed, right? The Fed has been hiking and tightened monetary policy with the goal of cooling things off. When you think about banks, and we've done some analysis and published on this in the past, is losses for banks. So there are two ways it impacts banks. One is growth slowing down, and you're seeing that in lending growth that has slowed down quarter over quarter over the last several quarters, I would say. And the second impact is, as rates go up, does it start having an impact on credit quality? And the higher correlation there is going to come down to what happens to the unemployment market. I think your previous guest talked about it. The job market remains extremely strong, a lot stronger than anyone of us imagined a year ago or 2 years ago. But that would be the driver of losses for the banks. But absent that, all you're going to see is a continued slowdown, less activity, so less fee revenue, less loan growth for banks.
And I have to get your top stock picks when it comes to not just regional banks, obviously still trying to find their footing here, but also the bigger banks as well.
So yeah, so I mean, in terms of the bigger banks, there's a couple of names that we've liked on the banking side are a name like Citigroup, where management's doing a lot of heavy lifting, cleaning up probably 20 years of mismanagement to get this bank on better footing. The other name that we've liked, and you saw some good news on them yesterday, was Wells Fargo, where it's a high quality deposit franchise, stuck with a lot of regulatory issues tied to their retail sales scandal dating back to 2016. And you got an update yesterday with the removal of the OCC consent order, suggesting that they are making some progress there. So those are the couple of big banks that we like. And among the regionals, there are a few institutions. If you look at a name like Fifth Third Bank, FITB, or M&T Bank, MTB, are institutions where they have ample liquidity, they're stress tested by the regulators, solid management teams.
Certainly continue to look into those and a lot of the nuances as you've been tracking as well. Appreciate you joining us. Ibrahim Poonawala, Bank of America Senior North American Banks Analyst. Thank you so much. Have a great weekend.
Thank you.
All right, well, we're looking ahead to NVIDIA earnings next week. Here's a look at what investors can expect.
NVIDIA is Wall Street's AI darling. The company's stock price is on a massive bull run, rocketing 380% since the end of 2022, and was the best performing component of the S&P 500 in 2023. With that said, here are 3 things we'll be watching for when the chip giant announces its fourth quarter earnings on February 21st. Artificial intelligence. NVIDIA is the tech industry's go-to provider for the powerful graphics processing units used to train and run generative AI models. Heck, Meta CEO Mark Zuckerberg announced that his company will purchase an incredible 350,000 NVIDIA H100 cards by the end of 2024 at a price tag well into the billions of dollars. Microsoft, Google, Amazon, Tesla, you name it, every company is clamoring for NVIDIA's chips. And those are just the tech giants. Smaller firms are also working to get their mitts on NVIDIA's offerings. And with the earnings season already showing continued AI investment across the tech industry, NVIDIA stands to continue to gain considerably. Market expectations. Expectations for NVIDIA's fourth quarter are sky high after the company stunned Wall Street in the prior period when revenue rocketed an incredible 206% year over year to $18.12 billion. In the fourth quarter, the company is projecting revenue of $20 billion plus or minus 2%, well above analysts' prior expectations of $17.8 billion. And Wall Street doesn't see the growth stopping anytime soon. Bank of America recently raised its price target in NVIDIA from $700 to $800. Goldman Sachs also raised its price target for the company to $800. It previously had a price target of $625 on the stock. Regulation and competition. Still, it's not all smooth sailing for NVIDIA. The company is contending with U.S. export restrictions, blocking the sale of some of its high-end chips to China, one of its largest markets. And while that isn't hurting the company for now, it could mean the chip giant misses out on potential future sales. Then there are rivals. AMD and Intel are slowly but surely building out their own high-powered AI chips, with AMD in particular gaining on NVIDIA's tail. That company says its latest MI300X chip can go toe-to-toe with NVIDIA's H100, a claim NVIDIA refuted via a blog post. Even NVIDIA's own customers, including Microsoft, Google, Amazon, and Tesla, are building out their own AI chips, which could cut into the total addressable market for third-party AI chips. Still, those threats are relatively distant at this point. NVIDIA is still riding high at the moment, and we'll find out if it can keep the hype train rolling when it reports its results February 21st.
AI-generated movies could be right around the corner. OpenAI unveiling its new text-to-video model dubbed Sora. Now, it can generate videos for up to a minute long based on what a user prompts. And I mean, what we're looking at right now, this was barely even 4 sentences of a prompt to create this. You get multi-shot angles, high definition. You can put in if you want it to be drone shots, if you want it to be slow motion. You basically put in the background, the location, everything. I mean, some of it's visually, it's stunning.
It looks like 4K. Oh, that is cute. That reminds me of my dog. I don't know if it reminds me of your dog. It's so cute and small. But it looks incredible. And for people like us, it obviously leads to a question about what's going to happen to content creators in the industry. I feel like in our morning meeting, we were all a little bit stressed, but also there's the other part of it where maybe it makes our jobs easier. Maybe we don't have to spend hours and hours shooting B-roll and we can just type in traders, New York Stock Exchange, somehow make that beautiful.
I mean, it's true. I'm looking at some of the feedback here. Tim Brooks was a research scientist on the project. He said it learns about 3D geometry and consistency, but he said they didn't actually bake that in. It was just entirely emerged from seeing a lot of data. So really going to show just how much this can evolve, even some of these unexpected outcomes. I mean, if you look at some of these visuals here, you also have to wonder, though, when you see images of people, intellectual property, what does that mean for that? Since this isn't an original generation here, it's based on this source data, something that we continue to see here. And also, if you're a makeup artist, an actor, if this really ties in, especially on the heels of a newly negotiated deal for the Screen Actors Guild and for the actors and artists in the industry, I don't know if this is a level that they could have anticipated when they were trying to future-proof their jobs here.
Right, it's such a great point, and we should also mention that OpenAI did not release any of the details about what went into this, about all of kind of the ingredients that went into the secret sauce here. They're keeping that private, and so not knowing the extent of those capabilities may allow us to have a little bit of solace that maybe there's a lot more time between something like that being super usable for folks in our own newsrooms around, video and content creation more broadly. Maybe we've got more time before we see super disruption. But I guess if it puts makeup on our faces the way a TikTok filter does, I'm not super opposed to that. I don't know how you feel about this, Rochelle.
Well, it's one of those things. If you suddenly move to the left, I know I like to move a lot, and your makeup is still sitting 5 inches to the right.
Suddenly off the face.
Nobody wants to see the before and after on that. It is worth noting, though, they do have a team who is testing it for harms and risks at the moment.
Right.
Because we keep having this issue of this technology moving faster than regulators can keep up, and some of the harms that we're still not aware of, as we mentioning here from that research scientist, something you can't plan for what you can't plan for.
Right.
So really, at least being thoughtful about how this is being deployed. But this text-to-video, I mean, it's pretty incredible when you look at just the ultra 4K detail that you're seeing on this.
You bring up a great point, though, which is some of the risks. And the CEO did mention that they have red teaming coming up for Sora. That's what they call the kind of team of specialists that test their AI models, make sure that they're not, open to big cybersecurity threats. They basically act like bad actors, try to make something bad happen with the tools in order to kind of prevent against that in the future. Saying that a spokesperson from OpenAI saying that they're going to assess critical areas for harms or risks. So interesting to see as we continue to hear about cyber threats, across all industries. We were talking about that with DraftKings earlier. How is that going to play into this, particularly when, to your point earlier, there are so many questions about kind of the use of people's identities in this material moving forward? What is that going to look like, and how are they going to pressure test that against any cyber hacks moving forward?
Indeed, still a lot of questions. I mean, at least I guess if you're a creator, you've got some options there in terms of a quick start here, but
right.
A lot of questions indeed.
Yeah.
All right, well, before we head out, let's get you a quick check of the market. Still looking at red across the board, although still trading in a relatively narrow range. Currently seeing the Dow there down about 0.2%. They're losing about 72 points on the day. Looking at the S&P 500, they're off about 0.25%, still relatively flat. Tech-heavy Nasdaq taking the biggest losses so far this morning, down about 81 points, or about 0.5%. Well, that does it for myself and Maddie today, but stay with us here on Yahoo Finance.
Welcome to Yahoo Finance and happy Friday. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita, and here's what I'm watching. Investors hit with another hotter than expected inflation print this week. Stocks trying to find footing as fresh economic data raises doubts over the path of interest rates. Investors also digesting what this earnings season has revealed about the road ahead for food companies. We're going to take a look beyond the caution surrounding the state of the consumer. And game on for Microsoft, the tech giant announcing it will bring 4 Xbox games to other companies' consoles. What does Microsoft's new gaming business era mean for investors? Well, more on that later this hour. But first, though, let's take a look at where markets are trading 90 minutes into the trading day, and we are seeing investors react to that hotter than expected PPI print, producer price index. The Dow down 69 points, the S&P 500 down 7, and the Nasdaq down 66. By the way, the producer price index seeing its biggest move since August, so certainly not the direction the Fed would like things to be moving in. Let's take a look at where Treasury yields are trading right now, because remember, we kicked off the week with a pretty choppy trade here on this front. We are seeing things move higher. The 5-year yield at 4.29, the 10-year yield at 4.3, and the 30-year yield at 4.46%. Let's get to Yahoo Finance's Jared Blickery to kick off the show with a look at the roller coaster week that was. Jared,
yes.
Where do things stand?
Things stand well. Actually, the S&P 500 not only down for the day along with the Nasdaq, but down slightly for the week. And as you said, this was a roller coaster. We had that hot PPI print this morning. Tuesday was the real doozy. That's when we saw stocks take that big dive, and they've been working ever since to try and claw their way back. We got almost, well, we did get a little bit in the green yesterday, but we are back in the red for the week today. And let's take a look at the small caps, because they have been the most volatile, and they're actually in the green for 1.44%. But it looks like the S&P 500 and the Nasdaq are going to probably snap their 5-week winning streak. The Dow, I believe it's just positive. Let's take a quick look there. Up 4 basis points. If it closed here today, be up 6 weeks in a row, but we're just kind of splitting hairs here. What matters is what we're seeing in the sector action today. Materials and healthcare is leading. Let's take a look at the 5-day totals, because materials, again, number 1, followed by energy and financials. Then we got utilities, industrials, and healthcare. All in all, this is really a value and cyclical and a little bit of a defensive play. So some sector rotation, because what we're seeing in terms of the losers here, tech, consumer discretionary, also communication services, just about in the green or red there. Those are the 3 mega cap sectors, and those have not done as well this week. Here is the Nasdaq 100, and you can really see a picture in 1,000 words here. The mega caps suffering a bit, depending on which one. Meta and Nvidia in the green here, but Alphabet down 5%, Apple and Microsoft down 3%. But let's take a look at the biggest winners and losers here. Diamondback Energy, that's FANG, that's in the upper left. That's up 18%, followed by Applied Materials, a chip company, then JD and Pinduoduo. Those are 2 Chinese companies. The list goes on, but really not a lot of outperformance in terms of a theme or thematically that I'm seeing at the top or the bottom. Adobe, by the way, down 10%, and Biogen down 9%. Let's take a look at some of the leaders in our leaders and sentiment makers. And we have Bitcoin. That's up about 9% for the week. That is our biggest gainer, followed by, again, those Chinese stocks up 5%. And then a smattering of some fringier parts of the market. IPO, small oil, tanning, that's solar, and then disruption. So we've seen some of the fringier elements reassert, and we've also seen the mega caps take a little bit of a backseat. So sector rotation.
Okay, we'll continue to watch. Jared Blicker is always breaking that down for us. Well, another hotter than expected inflation report raising questions about when the Fed will cut rates, while consumer inflation expectations for the year ahead inched higher. Here to assess the best investing plays amid a roller coaster week for markets, let's bring in Luis Alvarado, Wells Fargo Investment Institute Global Fixed Income Strategist. Luis, good to talk to you today. So on the one hand, we got 2 inflation prints this week that seem to suggest that things are not necessarily moving in the right direction or moving along as smoothly as we would like. And yet consumer sentiment up for 3 straight months. We are at a high we haven't seen in more than 2 years. How do you weigh these two?
Yeah, there's definitely some type of lag over there in the data, right? What we get from consumers is that they still feel that the job market is improving, that's still good, and inflation will eventually come down as well, right? So The CPI and PPI being kind of lagging indicators, not confirming that. However, we do believe that the expectation moving forward over the next few months is that we're going to start to see inflation come down. So the question is going to be, was this just a bump on the road, or are we really going to see some inflationary pressures pick up? In that sense, that would bring us to a tailspin, because it's a tail risk that consumers or investors are not really considering right now.
How do you see it, Luis? I mean, was this the bump that was expected in the eventual end of the road, which is the beginning of the rate cutting cycle, or is this a sign that things are not necessarily moving in the right direction?
Yeah, the way that we view it is that this essentially could be a bump on the road. We're still expecting some sort of slowdown over the next 3 to 4 months, pretty much the first half of the year, and then an eventual recovery. But to Chair Powell's point, when he took March out of the table, it was still too soon to start pricing sort of the aggressive rate cuts that the market started pricing since late December, right? So they got ahead of themselves. The Fed doesn't want to make the same mistake that they made in the 70s, in that they cut rates too soon, too fast perhaps, and the economy is still chugging along. So I think the Fed is going to be cautious. On our expectations, we still believe that most likely 3 rate cuts is what the Fed is going to give us in 2024. We pushed out the data a little bit further, probably May, even though probabilities are declining, it could be June. You get mixed up a little bit with the Fed balance sheet and what they're going to do on tapering. So I would say it's still vulnerable, right? On the other hand, the other tail risk that other market pricing or other market participants are not pricing is that if inflation stays sticky, right, the Fed could bring back again another rate hike, right, which is pretty much not really talked about right now.
It's been a choppy week in treasuries. When you look at where things are right now, the 10-year, right, just below that 4.3% level. I mean, what's your expectation moving forward? Is it going to push higher, above 4.5%, or are we kind of in that spot that we're expected to be, despite shifting expectations of when that rate cut will begin?
Yeah, yields are very reactionary, and you're going to continue to see yield reaction as we continue to get more data, incoming economic data over the next few months. The reactions we saw today is pretty normal, I would say, just in the sense that rate cuts are being priced to be pushed out. When you look at fundamentals, for example, on the 10-year yield that you were mentioning, we could do a quick, simple math, right? You look at inflation expectations over the next 10 years, probably around 220. You think that the Fed is going to probably want to keep real rates at about 2%. If you just do that simple math, that brings you around 420, add a little bit of a term premium, and you can hike a little bit higher or perhaps a little lower. But another thing in the mix that hasn't been kind of thrown out there is obviously all the situation with the fiscal deficit of the U.S., the amount of Treasury issuance that we can continue to see as 2024 continues to progress, and that could continue to add pressure to yields. So we're still believing the tale of two halves. The first half of the year, we could perhaps see yields move lower as the consumer slows down a little bit and inflation gives way, allowing the Fed to do some rate cuts. But then towards the end of the year, we expect that recovery. And at that point, we expect kind of yields to move back up higher because the economy will continue to grow at a better momentum. And also because perhaps we still have kind of the lingering risk of the amount of government debt, the amount of deficit, and the amount of Treasury issuance.
Mm-hmm. So, Luis, how are you advising clients? I mean, do you go for corporate debt? Do you go into treasuries, maybe on the longer end of the curve? Where do you position yourself?
Yeah, we're not really advising clients to take a pretty brave stance on the long end of the curve. Pretty much when we saw the swing back on yields at the end of 2023, we removed our long duration call. We're more neutral duration, neutral long term. We think investors should be positioned all across the curve. Obviously, the most attractive place right now is short-term fixed income, and we consider short-term fixed income anywhere between 1 to 3 years. If you have investors that have been over-allocated with excess cash holdings, money market funds, 3-month T-bills, it could be a good opportunity to lock in and move a little bit out of that ultra-short into that short-term fixed income, especially if we believe that the Fed is going to cut rates in 2024, which is still our base case, right? So from a positioning perspective, I would say follow your objectives. Short is the most attractive, but there's definitely opportunities to be done in that belly of the curve, that intermediate. And then you mentioned investment-grade corporates. Yes, that is a good sector that we like as well. We don't think investors are really pricing in any sort of like risk in the credit markets. If you look at credit spreads, they are close to all-time lows. So investors are not really pricing any credit risk at the moment. The maturity walls that could be a threat to investment-grade corporates or high-yield corporates even seems to be a little bit far out still in the calendar. So no real pressure seen there. It's a good opportunity to collect the income, right? Lock in attractive yields, and then investors will be able to enjoy that income.
Luis Alvarado, Wells Fargo Investment Institute Global Fixed Income Strategist. Appreciate you stopping by today.
Thank you.
Coming up, we're going to be diving into the food industry. We'll break down the key themes from earnings season next. Shares of DoorDash under pressure, down more than 10% right now, despite the delivery giant beating expectation in its latest quarterly results. To discuss how this compares to what we're seeing across the delivery industry, we've got our very own Brooke DePalma breaking down the numbers for us. Brooke, there was growth there, but not enough for investors.
Yeah, good morning, Akiko. Investors certainly disappointed this past quarter as DoorDash, Uber Eats, Instacart, this crowded, competitive landscape for food delivery continues to rise, especially as they all try to navigate this post-COVID world. So let's break this down in three different ways. First, I'm taking a closer look at DoorDash's marketplace gross order value that we saw last quarter? Well, it increased 22% to 17.6 billion. And like you noted, that beat expectations. But it's important to note that that year-over-year growth is less than what we saw the same time period last year when we saw year-over-year growth up 29%. And we heard a similar anecdote earlier this week from Instacart. They saw orders grow, albeit at a slower pace than compared to the year prior. And now DoorDash is, for its 2024 outlook, they do expect gross order value of $74 to $78 billion. That's slightly below consensus estimates, and that's really putting pressure on shares today. Now, the second thing I'm taking a closer look at is revenue comparison of DoorDash's revenue for Q4 compared to Uber Eats revenue, that Uber delivery service in Q4. And when you take a closer look, you could see that DoorDash brought in $2.3 billion. Uber Eats brought in about $1 billion more at $3.1 billion. A crucial factor here that's really important to note is that this is not the only revenue stream for Uber Eats. Uber also has that freight business. Uber also has the ride business, which is a huge part of their Uber revenue stream. So total revenue for Uber this past quarter was $9.9 billion. They're generating more cash, and they're also providing a greater return for investors. Both companies, DoorDash and Uber, announced buybacks recently. Uber coming in with a $7 billion buyback, DoorDash coming in with a $1.1 billion buyback, and ultimately Uber just has more cash on hand. Uber has nearly $4.7 billion cash on hand. DoorDash has $2.7 billion cash on hand, and a JP Morgan analyst writing in a note that Uber is the global leader in rideshare and grocery delivery. So we'll continue to watch how this landscape plays out over the next year.
Okay, interesting to watch how the competition is playing out there. Brooke, thanks so much. Well, sluggish store traffic combined with wage pressures are weighing on fast food restaurants. The latest earnings pointing to consumers pulling back on spending, opting for more value with tighter budgets. We've got a panel lined up to discuss which companies are best positioned in this environment. Sean Dunlop is Morningstar Senior Equity Analyst, and Peter Saleh, BTIG Managing Director, Restaurant Analyst. Good to talk to both of you today. Peter, I'm going to start with you because it feels like restaurants are kind of getting squeezed on both ends right now. You've got the wage pressures, you've got the cost of food, yes, coming down, but still pretty elevated. And then you've got consumers who are saying, well, we want better value right now. Who do you think is best positioned in the landscape?
Yeah, so thanks for having me on. Look, I think all those are true, but the U.S. consumer is actually doing quite well. But not all consumers are created equal. So if you cater to that lower income consumer, you are feeling some pressure, and that's the traditional QSRs that you see out there, the hamburger QSRs with the drive-through. They are feeling some pressure with that lower income consumer. But in general, the consumer is pretty good. I mean, you look at the numbers from Chipotle, mid to high single digit traffic gains in the last quarter. Look at the numbers from Texas Roadhouse, mid single digit traffic as well. Shake Shack, so Wingstop. So you're seeing some really healthy numbers out there. Overall, I think the consumer is healthy. But again, the lower income consumer is still pulling back, and those discounts are designed to bring them back in, but it has not worked quite yet.
Sean, Peter just mentioning that all consumers are not the same. We had a guest on yesterday who said, look, when you talk about consumer-facing brands, it's not necessarily the blame on the consumer so much as it is about companies not being able to execute in a certain environment. So when you look across the landscape here, who do you think is executing the most? I mean, how do you think investors need to differentiate some of these names, even though the overarching narrative is out there?
Yeah, it's a great question. I think as we look across the restaurant landscape, there are kind of two sets of factors right now. One of them is exogenous, that ties to consumer health, that ties to the value-driven decisions that some of them are making. The other point, as you rightly make, is that these brands are different operationally in a number of ways. We like, in the current environment, brands that are positioned to cater to consumers' desire for value. You think about pizza chains like Domino's or Papa John's. You think about historically McDonald's being able to compete on the value end of the menu. Barbell pricing is obviously very popular right now. But we also like brands that have strong digital touch points. You think about a Chipotle that does 30 to 35% of its sales through digital channels. You think about Yum Brands doing 45% of system-wide sales through digital channels. And you think about brands like Starbucks and McDonald's that have massive loyalty programs and are able to meet consumers with personalized value messages that cater to them, propping up traffic without relying on costly national discounting. And those are the brands that we expect to continue to outperform in the current environment. We do like Starbucks, we do like McDonald's. We think the current environment favors the biggest, best run restaurants, and we think that's a dynamic that's likely to continue to play out over the midterm.
Peter, you agree with that? A name like Starbucks, having that loyalty sort of buy-in, does that make it a little stickier than maybe some other competitors?
Yeah, so look, we like Starbucks. We're buy rated on the name. We think it's one of the large cap names that's really underperformed versus the rest of the group. Look, I think it's getting hurt right now because of its exposure to China, which makes up, call it 15% of its sales and 15 to 20% of its operating profit. And China is under pressure. Outside of that, the U.S. is obviously their largest market, and they're doing okay in the U.S. So look, we like the Starbucks story. I think that one is going to have a pretty good year as well. We agree on Domino's. I mean, Domino's is our top pick for this year on the large cap name. It's got a lot of self-help. It's got this partnership with Uber Eats that's rolling out or has rolled out. I think that's going to be a big tailwind for them in 2024.
Peter, one of the big potential headwinds we're watching right now is in California, where you've got that new minimum wage kicking in, $20 an hour. Coming in April as a result of legislation that was passed in the state. How big of a concern is that for some of these names that you cover?
So I think these restaurants have really few options to offset that cost. One, automate, which is easier said than done. The other option is to raise prices. And I think the vast majority of them are going to be raising prices. The question becomes, are you raising prices to offset the dollar impact, or are you raising it to protect margins? Our impression is most of these restaurants will be taking a mid to high single digit price increase in California to offset the cost on April 1st. I think that's coming in the near future.
Sean, Peter, just talking about automation there, that's sort of the next lever we're looking to. We've certainly seen some of these brands, like a Sweetgreen, for example, make big investments in the tech space. What does that ultimately mean for what that footprint looks like for some of these companies in the space? Is it fewer workers? Is it more automation? What does that experience look like as a result of these particular wage pressures going up?
Yeah, it's a great question. I think in the long term, we're starting to get a sense of what's going to happen with Sweetgreen's Infinite Kitchen. We're starting to get a sense of what might happen with Chipotle's Hyphen. There's definitely an appetite to switch out OpEx for CapEx. That is to say, to trade workers for automation where it makes logistical sense. We're not quite there yet from an ROI perspective, but as wages continue to increase, we're certainly getting closer. What that means on balance is that we expect the bigger impacts to be software first, or to be loyalty program led first. We're very optimistic on restaurant software. We think that if you deploy certain modules like labor scheduling, like automated inventory management, like demand forecasting, like digital ordering, you're able to unlock as much as 3 points of margin. And we're starting to see that already in the restaurant industry. You look at a name like Darden that's been able to grow wages per store at a rate much slower than headline wage inflation. You look at a name like Starbucks that's trying to take $1 billion out of its P&L annually as it invests in some of these things. It's really important that restaurants get automation right, starting particularly with software and with the loyalty programs. And we think that's going to be a big opportunity, and that's going to really solidify the current industry hierarchy that definitely favors the biggest brands over the smaller and independent chains.
Sean Dunlop, Morningstar Senior Equity Analyst, and Peter Saleh, BTIG Managing Director, Restaurant Analyst. Good to talk to both of you today. Really appreciate the time. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Microsoft is opening up its gaming vault. Xbox is rolling out a handful of its previously Xbox exclusive games to Sony's PlayStation and Nintendo Switch. Microsoft's Xbox CEO Phil Spencer saying on a podcast Thursday the console maker will also release 4 exclusive video game titles on external platforms. For more on what this means for Microsoft's growth strategy, I'm joined by Lewis Ward, IDC Gaming, Esports, and VR and AR Research Director, alongside our very own tech editor, Dan Howley. Good to talk to you today, Lewis. You know, we've heard Phil Spencer say in the past this new strategy about making sure that every screen is an Xbox. How does this announcement fit into that vision?
Right, thanks for having me. So, yeah, it's true that Microsoft has been emphasizing the software and the capabilities of offering games on pretty much every screen that consumers have for several years now. So this is an extension of a strategy that's been out there for many, many years. And obviously, they want the best experience to be on Xbox console hardware. And then they've pushed into PCs to a significant extent over the past few years. And then mobile is more aspirational, but something they clearly view as a growth opportunity outside of most developed economies is going to be, can we put those same games in the cloud and offer it on iOS and Android devices that people have, counted in the billions worldwide.
Lewis, I want to ask, when it comes to Microsoft, their console sales are slower than the PlayStation 5, right? I think the estimate was Take-Two had said there were 77 ninth generation consoles sold, the Xbox Series S and X and the PlayStation 5. And Sony recently said that they sold 50 million PlayStation 5. So I guess that leaves 27 million Xbox units. So almost 2-to-1 difference. What does it mean now that they're thinking of taking these, or they are taking these first party titles to other devices? We heard Phil Spencer say that they're sticking with the hardware strategy, but it seems increasingly like they're moving to a software kind of focused side of things.
Yeah, absolutely. So the 4 titles are not like the crown jewels, right? It's not Halo, it's not Gears of War or Forza. It seems to be, Sea of Thieves, a live service game. Grounded was another one that appears to be. I don't think they've finally released the titles, but that's certainly the online speculation. And yes, I think there was a large share of Xbox players who were concerned that a lot of the crown jewels of the Xbox game studios are going to be eventually playable on PlayStation 5. And so that was the thing that really caused a lot of consternation, let's say, among the Xbox fan base. But Phil Spencer and company really tamped that down yesterday by saying, no, this is a limited approach that we're taking with 4 specific games that are a few years old at least. They are successful games, very high Metacritic ratings. And so the idea is to basically monetize a sunk investment at this point. And if they put it on PS5 and Switch, it sounds like they're going to go to both. All 4 games are going to go on both by the end of this year. It's going to be a few, I don't know, several $1 million more, right, coming into the Xbox ecosystem from a revenue angle, and hopefully grow some more fans even on competitors' hardware, as it were. So I think that's the plan, the vision.
I guess, what does it say then that people were nervous that Microsoft was just going to move out of the hardware business? I guess it gives the feeling that there's a sense that there's a lack of security for Xbox.
Yeah, and I guess there was a leak or something a week or 2 ago that hinted that it could be much more than what was ultimately announced yesterday. And presumably it's plausible that some games we don't know about will follow the same trajectory. I might add that Minecraft is a hugely successful game for Microsoft that's on every platform under the sun, and no one seems to particularly care about it. But yeah, at the end of the day, there has been significant concern that perhaps they're even going to get out of the hardware business, or that, again, some of their, real mainstay franchises, first-party stuff, are going to show up on other console platforms. And in effect, as far as I'm concerned, Phil Spencer and company, Matt Booty, Sarah Bond, basically said that is not going to happen for the foreseeable future, at least. So to my mind, the podcast interview really should have assuaged a lot of the concerns that were expressed by, Xbox gamers that expressed concerns that might happen.
Louis, you talked about the different faces, the different platforms we're seeing these games on. Mobile, you said still aspirational, not quite there yet. Where are the biggest revenue opportunities?
Right. Well, I should caveat that now that Activision Blizzard is part of Microsoft, that of course King, which is like the #1 grossing mobile studio, gives them a giant beachhead, and there are other games that King makes as well. So with the caveat that post acquisition, Microsoft instantly becomes a top 5 grossing publisher even on mobile. But beyond that, their first party games are generally PC or console centric, and those really haven't made the jump to mobile. But I expect over time that many more games from internal studios beyond what King has already been working on and whatnot, and beyond simply cloud stream gaming, that we will begin to see first party games that have perhaps not playing in the same environment, although Microsoft certainly loves cross-play and cross-purchasing, those sorts of things. But I think the first steps into mobile will probably be more like taking some first-party games, creating a somewhat different version of the game that's optimized for mobile, launching that and trying to grow it organically. And then we'll begin to see some more cross-platform IP where perhaps some players from PC and console may actually be playing against mobile players from a first-party perspective on Xbox/Microsoft.
Louis, I just have one more question. What's the big deal if they move some first-party titles to other companies? I mean, obviously, the idea with these first-party titles is, we have this hot game, come buy our console or come try our service. But I mean, for Microsoft, from a general revenue perspective, wouldn't it make more sense for them to just hit as many places as possible to get as many people to play the game as possible? Similar to what you said with Minecraft.
Yeah, it's kind of counterintuitive. Microsoft as a company, I would say, is very interested in subscription business models and putting its content. And this is certainly a case they made to the FTC for Activision Blizzard. So they don't want to change that story now. They want to be a means of putting their IP on as many platforms as possible. That's certainly the vision. But at the same time, there's this tension for consoles specifically where they do want to sell hardware. And it's absolutely the case that it remains to be true that for Xbox and PlayStation and Nintendo consoles, that first-party monster AAA games are system sellers, right? They're often bundled together with a themed controller and a look of the console design. The game is bundled for free at perhaps a price that includes that cost. And so it remains important. And Microsoft has said they're going to put out a next-gen Xbox console, probably not coming till 2028 or so. So we're looking at consoles from Microsoft coming through 2035, something like that at the least. And I think it's an ongoing tension, but the bottom line is that first-party exclusives are important to gamers. I think they listen to their gamers, and so we're going to see a bifurcated strategy of trying to do two impossible things, which is to have all games on all platforms possible to maximize revenue when you're third place from an install base perspective. That's an important vision to have, but also move the hardware and provide an experience that will, offer a best-in-class experience from their perspective with certain games that are only available in the Xbox ecosystem. And so I think that will just continue over time, but it's fair to say that Microsoft will probably lean more into that wider vision of games distribution, over the next few years.
A lot of moving pieces there. Louis Ward, IDC Gaming, Esports, and VR and AR Research Director, alongside our very own tech editor, Dan Halley. Thanks to both of you.
Thank you.
Well, we are looking ahead to NVIDIA earnings next week. Here's a look at what investors can expect.
NVIDIA is Wall Street's AI darling. The company's stock price is on a massive bull run, rocketing 380% since the end of 2022, and was the best performing component of the S&P 500 in 2023. With that said, here are 3 things we'll be watching for when the chip giant announces its fourth quarter earnings on February 21st. Artificial intelligence. NVIDIA is the tech industry's go-to provider for the powerful graphics processing units used to train and run generative AI models. Heck, Meta CEO Mark Zuckerberg announced that his company will purchase an incredible 350,000 NVIDIA H100 cards by the end of 2024 at a price tag well into the billions of dollars. Microsoft, Google, Amazon, Tesla, you name it, every company is clamoring for NVIDIA's chips. And those are just the tech giants. Smaller firms are also working to get their mitts on NVIDIA's offerings. And with the earnings season already showing continued AI investment across the tech industry, NVIDIA stands to continue to gain considerably. Market expectations. Expectations for NVIDIA's fourth quarter are sky high after the company stunned Wall Street in the prior period when revenue rocketed an incredible 206% year over year to $18.12 billion. In the fourth quarter, the company is projecting revenue of $20 billion plus or minus 2%, well above analysts' prior expectations of $17.8 billion. And Wall Street doesn't see the growth stopping anytime soon. Bank of America recently raised its price target in NVIDIA from $700 to $800. Goldman Sachs also raised its price target for the company to $800. It previously had a price target of $625 on the stock. Regulation and competition. Still, it's not all smooth sailing for NVIDIA. The company is contending with U.S. export restrictions, blocking the sale of some of its high-end chips to China, one of its largest markets. And while that isn't hurting the company for now, it could mean the chip giant misses out on potential future sales. Then there are rivals. AMD and Intel are slowly but surely building out their own high-powered AI chips, with AMD in particular gaining on NVIDIA's tail. That company says its latest MI300X chip can go toe-to-toe with NVIDIA's H100, a claim NVIDIA refuted via a blog post. Even NVIDIA's own customers, including Microsoft, Google, Amazon, and Tesla, are building out their own AI chips, which could cut into the total addressable market for third-party AI chips. Still, those threats are relatively distant at this point. NVIDIA is still riding high at the moment, and we'll find out if it can keep the hype train rolling when it reports its results February 21st.
Slowing demand for electric vehicles are leading to some big deals for potential buyers. Legacy automakers are dropping prices to entice drivers to make the switch. New EV prices slipped more than 10% last month alone, according to Kelley Blue Book. To break it all down for us, we've got our very own EV expert, Pras Subramanian, joining us. Pras, what kind of deals are we talking about?
You know, Akiko, just sort of this kind of thing occurred to me as I saw stats like the KBB stat you mentioned, seeing this imbalance in the marketplace where so many automakers push so deeply into the EV sort of narrative, and then now they're seeing that the fact that they've supply building up on the showroom floor. So first and foremost, I'm looking at some of the cheaper, more entry-level EVs, and one of the ones that crossed my kind of like scanner here is the Hyundai IXIC 5. Like, this is a great-looking, well-featured crossover slash kind of hatchback, and right now it starts at a pretty decent price of $41,800. But now Hyundai's offering $7,500 in cash back and also 0.99% financing for 48 months. I think that's a great deal. And kind of when you step up to the kind of the next level, you got to go Tesla Model Y. Look, Elon Musk antics aside, this is a great sort of entry level, not but kind of like a mid-size. You can get it in 3-row sort of format, but this is just a great car in terms of like just the feature set, the size, and also the charging infrastructure. I know, Kiko, you've had experience with Tesla as well.
Yeah, Teslas are good cars. I am currently driving an ID4 Volkswagen right now, but I'm looking at the average price has hovered around what, $50,000, maybe a little more in terms of EVs. I mean, what are you hearing is the sweet spot? In other words, these discounts that are coming through, what's the level they need to get to entice drivers to make the switch despite infrastructure, despite everything else?
Yeah, you know, prices were usually, I mean, not usually, usually were in the 60s level for a while now, and they sort of came down now to the 50s. I mean, I think that there's more and more cars that are in the $30,000 to $40,000 range that, like I mentioned, the Hyundai IXIC 5, but I think that below that sub 30s where you're really going to see a whole mass of people that I think that there's people out there that just can't afford them. And Elon Musk has said the same thing. And if you give them the right sort of feature set, the right price, they're going to be okay with the fact that they might not have the best range or might have the best charging infrastructure. You know, you mentioned that price set. I think one other feature, one other size sort of format that people are very excited about are the 3-row EVs, and that's where the Kia EV9 comes into play. This is a kind of a very good-looking 3-row SUV. Gets good range, and it's in that mid-50s price range that you mentioned. That's sort of where the average of EVs are. And the thing is, right now, Kia is offering $3,750 off that car for now, and 3.25% financing for 48 months. So there is a deal to be had there for a very, very, I guess, a popular car sort of format in the U.S.
Yeah, those Korean car makers, you know, really making a push with the competitive pricing out there. It's going to be interesting to see how the market share starts to shift up as a result. Pras Subramanian, thanks so much for that.
Thank you.
Workplace healthcare costs are set to spike more than 7% this year, according to a report. Although the prices are going up for consumers and employers, health disparities continue to be an issue. Those with lower incomes are significantly less likely to have a usual source of care compared to those with higher incomes, according to a Morgan Health report. To break it all down for us, we have Dan Mendelsohn, Morgan Health CEO, and Yahoo Finance's very own Anjali Kamlani. Dan, good to talk to you today. Why is it that these disparities still exist?
Look, I think it's really important for employers to understand that these disparities are really endemic in healthcare. And there are a lot of reasons why the disparities are there. It's really about the healthcare system. It's about availability of resources, primary care resources and tertiary care resources. And it's about affordability. And if employers can come together to really focus on these areas, we can make some progress.
Dan, good to see you again. Anjali here.
I want to dive into this affordability concept because I think it's important to note that the affordability part of the equation is both an employer problem and an employee problem. We've seen premiums rise over the year, 7%, as we mentioned, this year alone. But it has been something that employers have been focused on for some time. I know a Kaiser Family Foundation survey recently saw in the past 2 years that employers are focused on this, and 87% of those respondents did say that they anticipate that the growth of premiums is going to be unsustainable, and the cost of healthcare is going to be unsustainable in the next decade, up to a decade. So I want to dig into that and sort of how that plays a role in these, in these disparities, because I think it's something to be talked about when it comes to how we're funding healthcare in this country. No?
Costs are going up, and that's a major issue for small businesses as well as larger businesses. I mean, that's an indisputable fact. I think that the issue, though, is bigger than that, because we see disparities irrespective of whether an employee is well covered or not. And so these disparities go back to the way that healthcare is being delivered and in the nature of how people are being treated in the healthcare system. So what's really important is that employers understand the disparities and that they're not just about the rise in spending, and that they hold their providers and insurance companies accountable for making improvements in those areas.
How can that happen, though? Because as far as I've ever heard, and correct me if I'm wrong, employers are sort of seen by the insurance industry as moneymakers, right? They have employees that they need to entice and take care of, and therefore they sort of maybe bloat up, the benefits, and the plan design is based on that need, rather than some of the other metrics that are used, say, in the exchange and other areas like with the government, when the idea is more of an efficiency play. And so we've seen, because employers are about half of the insurance industry's revenue in the country, I just wonder how they can be, I guess, taken advantage of less. Like, what do employers need to do to start bringing this conversation back in their favor?
That's a great question, and that's really the focus of Morgan Health and what we're all about. I'd say that look, employers pay for about half of the healthcare in this country. About 180 million people are getting their insurance through their employer, and it's really, large corporations like JP Morgan Chase spends about $2 billion a year on healthcare for workers. And what that means is that we can have conversations with our insurers, and we can drive expectations, and we can make the expectation clear that we, as a payer, really expect to be paying on the basis of value, and that we consider health equity to be a very core component of the value that we are receiving. So we want to make sure that all of our employees, all cohorts of our employees, are being treated well, and those are the discussions that we're having. And then part of it also is in education. I mean, look, one of the findings from our study, which is really important, is about C-sections for low-risk pregnancies. And what we see in the study is that employees nationally who are Black will have higher rates of C-sections for uncomplicated deliveries than white employees. That's wrong. And we have to get on top of that. We have to understand the mechanisms of that. And as employers, we have an opportunity and an obligation to make sure that the insurers who are working with us are on top of this.
Absolutely. I know on the other side of that equation, there's a lot of focus on maternal mortality in this part of it. So there's a whole discussion there for sure. Meanwhile, another finding was that sub $50,000 income employees are also less inclined towards having a stable place of care, usually ending up in the emergency room or urgent care. I think that's something the industry has been contending with for years, and telehealth sort of helped that. But we are in a different environment with more of a retail health push. Are there ways that, say, the Walmarts of the world, the Minute Clinics of the world, the Amazons of the world with One Medical can reach these populations in a way that's more cost efficient, even for an employer?
Yeah, absolutely. I mean, one of the things that we're doing right now in our environment with our portfolio company, Apri Health, is that we're bringing primary care into the workplace. So, there's this idea of a clinic in a workplace. And typically that's really been about getting vaccinations and getting, a Band-Aid if you cut your finger. And what we've done is brought in a really outstanding primary care clinic into the workplace. And what this means is that our employees, as they're walking in, will walk past that clinic and they'll be able to avail themselves of those opportunities. And that's the kind of thing that really reduces the barriers to care, and we believe can improve health equity in addition to outcomes.
Dan Mendelsohn, Morgan Health CEO, and our very own Anjali Kamlani joining in on the conversation. Thanks so much today.
Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, lithium prices spiked back in 2021 before crashing back to earth at the end of last year. But it could just be the beginning of the fallout. Let's bring in Yahoo Finance's Inez Ferre, who's been tracking prices for us. Inez, how much of this is really tied to the EV demand? Obviously, lithium being a key ingredient there.
Yeah, that's right. Oh, well, a lot of this is tied to the slowing EV demand. And we did see prices really crashing over this past year, as you had mentioned. And we have a chart to show you just how much they have fallen. But look, it's no question that there's an oversupply right now in the market of lithium. China dominates this market. You do have U.S. players in the market as well, and you've got companies in North America that have been really expanding their plans to mine lithium, to extract lithium, to refine it. Albemarle posted its results this week, and analysts were glad that the company is going to be spending less now that the prices are down for lithium, because it really doesn't make sense to go through with so many projects, scaling projects, if you are seeing the prices of lithium so low. That adage in the industry that the cure to low prices are low prices. Albemarle saying that it is going to be scaling back a project in South Carolina. It also had announced some layoffs at the end of January. Piedmont Lithium is another company that also announced layoffs. We interviewed their CEO earlier this week about the lithium market, and he says we're clearly in a bear market. What does this mean? It means that projects are being delayed. It means that some projects are being sidelined. And look, there's no question that the longer that interest rates stay at an elevated rate, the cost of capital obviously is higher. So until that EV demand comes back, these companies are sort of in this bear market. Now, I will say that everyone that I've spoken to in the lithium space believes that the EV slowdown is exaggerated. They do believe that this is going to come back to a deficit of supply in the market. It just depends how long.
Yeah, we've heard over and over that there is a second wave that's coming. This is kind of the lull in between, but of course we're going to be watching what that means for lithium demand moving forward. Inez Ferre, thanks so much for that.
Thank you.
That does it for me in the 11 a.m. Eastern hour. As we look at the markets right now, a split picture with the S&P 500 trading pretty flat right now. The Dow flat as well, as investors continue to react to that hotter than expected PPI print that came down today. Much more to come here on Yahoo Finance. Keep it right here.